nature of Islamic finance, you know that rooted in adherence to the Sharia principle distinguishes in it from conventional finance in many aspects, just like fiduciary responsibility of the board of directors, senior management, with respect to to safeguard the interests of the investment account holders. IFE standards are pivotal in ensuring that all financial operations, products, and contracts of Islamic financial institutions are fully compliant with the Sharia. It is my distinct honor to welcome all of participants to this public hearing on the draft, which is the third public hearing. The last two public hearings were held on 4 July and 23rd July, respectively. It is the third one because this standard is the lengthy one. So I suppose this year's hearing marks a significant milestone in the IOP ongoing efforts to enhance the governance framework within the Islamic finance. The public hearing basically provides a platform for constructive dialogue where various suggestions, feedbacks, comments are provided by the industry players, all stakeholders, directly or indirectly, to ensure the robustness and relevance of the proposed standard. The standard draft standard we are discussing today aims to establish a robust governance framework for the governance and management of the investment accounts, ensuring that these accounts are managed with the highest standard of transparency, accountability, and Sharia compliance. This is crucial not only for the maintaining the trust and confidence of the investment account holders and other fund providers, including all stakeholders, but also for the sustainable growth of the Islamic banking and financial industry. We are privileged to have with us today a distinguished panel of experts who have contributed to the development of this standard under the supervision of brother Umar Mustafa Ansari and Zaid Khokar Saab. It is also honor for me. I have also contributed as a senior research associate in this draft. Their insights and expertise have been invaluable in shaping a comprehensive and practical governance framework. Finally, I say that IOFI standards support the international recognition and growth of Islamic financial institutions by following and compliance these standards. Islamic financial institutions can gain credibility and acceptance in the global market across the board, which is crucial for institutions looking to expand beyond their home territories. Conclusively, I say that Islamic financial institutions should rigorously adhere to IOFI standard. These standards are not just guidelines, they are the foundation for the maintaining the integrity, sustainability, and global acceptance of Islamic finance. By adherence to the IOFI standard, Islamic financial institutions not only fulfill their fiduciary obligations and religious obligations, but also position themselves as trustworthy, competitive, and innovative players in the global financial landscape. I firmly believe that the implementation of the current draft, especially the guidance on governance and management of the investment account, which is a very critical and main pillar of the Islamic banking industry, will significantly contribute to the stability, credibility, and growth of Islamic financial institutions. Thank you once again very much for the IOFI team, Umar Mustafa Saab, all the panelists, working group members, for your time, and I look forward to the fruitful discussion that will inshallah follow. Thank you very much, Zara.
Thank you, Brother Islam. Now I would like to invite Brother Umar Mustafa Ansari, the Secretary General of IOFI, to start the discussion. Brother Umar.
أعوذ بالله من الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. Ladies and gentlemen, distinguished scholars, experts, Assalamu alaikum wa rahmatullahi wa barakatuh, and good morning, actually good afternoon and good evening also for those who are joining from different parts of the world. Thank you very much for being with us today. Thank you very much, Brother Islam, for the initial remarks, and Sister Zahra and the team for arranging this one. Thanks to all of you for being here. It's a good enough number for public hearings, but I thought that considering the significance of this one, we should have a higher number of participants. And I think just to confirm, Sister Zahra, it's second public hearing or third public hearing? I think we held round table in between as well, but this
We
one
have
is
a round table and two public hearings.
two
One
public
in
hearings. So I think one public hearing after this also need to be done, I think. Am I right?
Yes.
Okay. And Arabic public hearing will also be conducted shortly. Am I right?
Correct.
Okay. So it's still like, you all guys will have, inshallah, an opportunity to provide your comments today and after that as well, inshallah. Probably we will be keeping this standard exposure draft a bit open because we have received some comments whereby some regulators and other market participants feel that certain parts of this standard are a bit difficult to implement or costly to implement, or they need to impact, like, the infrastructure, the business model, and other things as well. So from that perspective, I think there are several issues that need to be settled down before we finalize this standard, and maybe a little bit of flexibility, transition time, and some, like, consideration for some different type of institutions, small institutions, the proportionality requirement. These are the things that might be need to be considered, and probably we'll be looking towards all of you to provide your specific comments in respect of those areas where you feel that a flexibility or transition time would be needed. Let me just take a couple of minutes. Actually, this is a huge standard, very long standard, and covering it within 3 hours, like, actually less than 3 hours, because we have some time for welcome remarks and some time for a prayer break. So effectively, roughly 2.5 hours would be sufficient for it, considering the level of depth of the standard. But still, I think it's very important that we at least try to have a quick brief about the standard. So from where the need of this emanates is that while on different standards of governance of AAOIFI has been working to identify the areas where the unique business model and the structure of Islamic financial institutions, particularly the Islamic banks, which is the largest part of the Islamic finance industry, they have to be, like, to how to put it, that they have to be, like, aligned with this overall governance framework that AAOIFI has offered and the standards that we are developing. So that alignment part is always there, and we always say that our governance standards primarily add to the conventional governance standards 2 aspects. The first aspect that we add to the conventional governance standards is the Sharia governance part, the Sharia part, where the governance standards become necessary to get the Sharia principles and rules implemented. So, for example, you can have the best set of Sharia principles and rules, but unless you don't have a good mechanism of governance and controls to get those Sharia principles and rules implemented, you cannot have like, those rules really implemented. And what they say as a saying, that the taste of the pudding is in its eating. So at times you can just have all those good principles and rules of Sharia just kept on a shelf, rather than being actually implemented in the transactions and in the business of the institution, because there is an absence of the controls and governance requirements related to Sharia governance, which ensure implementation of that. So, like, we have Sharia board, we have Sharia audit, we have Sharia compliance function, we have so many different aspects of governance that ensure that. The second part of the second difference from the conventional standards that we have is what we call additional fiduciary responsibilities. And the additional fiduciary responsibilities are where the business model of Islamic finance is having a unique structure whereby the responsibility of the institution towards safeguarding the interest of the stakeholders is more as compared to the conventional institutions. So let's take an example, like most simple example is that if I go to a conventional bank and make a deposit, what I need to see in them? What I need to see in them is that they should be credit worthy, and they should be like able to return my money with interest after a given period of time. For that purpose, the central banks make sure that the banks are credit worthy. They make sure that they have enough buffer in form of regulatory capital requirements, etc., just to make sure that the bank has the solvency and the liquidity and the credit worthiness to pay back my money with interest. But I am, as a stakeholder, I'm least concerned about how they use my money, because the asset side is completely cut off from the liability side of the bank and on the conventional side, which means that irrespective of where they put the money or whether they earn money or they lose money or they waste money, they are still liable to pay me back my money with interest until the time they are solvent and credit worthy. Till that time, I have no concerns. But let's take the same example that I go to a bank, but this time the bank is an Islamic bank which takes money on a mudarba basis in an investment account. And the first bank said to me that I get a 5% interest, and this bank says that I get a expected return of 5%. Now, there are two aspects. Number one, for example, the Sharia compliance aspect that we discussed earlier, that if they invest the money in non-Sharia compliant, Sharia non-compliant avenues, it means that effectively they are not fulfilling their responsibility towards me, because they had a commitment that my money will be used for Sharia compliant purposes, Sharia compliant investment and financing avenues. And for this money cannot be used for impermissible means. I did not intend originally that my money can be used. And since my asset side and liability side are not cut off with each other, my returns are dependent on the underlying returns of the of the investment instrument. It means that effectively they cannot cut me off, and my responsibility, my rights on the underlying asset remain in existence, which means that they have to safeguard my interest on the Sharia part. But not only this, because of this specific business model, they have to safeguard my interest on the fiduciary part as well, that the responsibility as Amin, responsibility as fiduciary or trustee with regard to using my money in a right way still remains their responsibility. And they cannot just waste my money. They need to invest my money carefully, with prudence, while safeguarding my interest according to the risk appetite that I have agreed with them in my investment contract. And they cannot go beyond certain agreed parameters and limitations. Even if it is a restricted investment account, the primary considerations related to Sharia compliance and the primary considerations related to my risk appetite should be adhered to, which means that it is not that they just give me a 5% return irrespective of whatever return is earned on the asset side, but rather they have to make sure that they earn a return according to the expectations, so that my expected return becomes actual real return after doing all the computations. This way, the business model and the Sharia related requirements of the Islamic bank, which becomes different from the conventional bank. Again, it applies to all Islamic financial institutions, but this investment account standard is mainly about Islamic banks and similar financial institutions. So here we can use the term Islamic banks as well. So the Islamic banks versus conventional banks, we have this huge difference of that need to be applied. This emanates in additional responsibility. So on one side, we have the Sharia-related requirements, but on the other side, we have the additional fiduciary responsibilities. That is, we need to safeguard the interest of the stakeholders. This whole exercise that we have done for this standard, and just to mention that we have done a similar exercise on the accounting side as well, where we have improved the accounting standards on investment accounts, and both of the projects were initiated more or less at the same time, and the accounting part was completed already last year. By end of last year we completed this exposure draft we issued last year, and this year we intend to finalize it. However, together with the financial accounting standard, obviously we have the Sharia standard in place already. So putting the Sharia standard, accounting standard, and governance standard together, we come up with a comprehensive solution that need to be applied for investment accounts. Now, what is the need for having governance standard in addition to a Sharia standard? You will see that this standard is quite detailed and goes into much more depth as compared to Sharia standards, and it does not redefine the Sharia requirements, but it actually addresses the challenges of how to implement the core Sharia principles and rules, and how to safeguard the interest of the stakeholders with the principles of fairness, justice, and equity. This is the whole crux of this standard. One just important thing, that this standard encourages high-risk investment accounts, which are closer to the main concepts of Sharia. And we believe that I'll explain what is the difference between high-risk investment accounts and low-risk investment accounts later. But in a nutshell, this standard is an effort from AAOIFI to encourage better practices in the markets, to ensure that the Sharia compliance in investment accounts is getting better and better. Before I conclude my opening briefing on this standard and will take you through the standard, I would like to mention one thing, that one of the reasons where we have seen a lot of Sharia non-compliances and a lot of compromises on the Sharia in case of investment accounts and similar like quasi-equity instruments. One of the reasons is that the competence level of relevant people, starting from the product people, finance people, with due respect, the Sharia teams and Sharia scholars, because it requires too many complex things. It's a combination of knowledge of Sharia and the business and the accounting and all and even the IT. And unless you have a very good integration of all these efforts, you cannot have proper Sharia compliance and fiduciary responsibility compliance in respect of these instruments. And this standard is trying to develop that capacity, and maybe in the future, AAOIFI is intending to come up, although we are doing workshops on these areas for last several years, but probably we might be coming up with a certification program specifically on the investment accounts. So with that, I'll now move to the presentation. I'll share the presentation. Just a request that put all your questions. There are a couple of comments coming in the chat window. The request is, please, everybody, put your comments in the question and answer tab, not in the chat window, please. It will be difficult to manage it. So anybody who has put in their comments in the chat window, they are requested to kindly put them in the Q&A tab. It will ensure that we don't miss out your comments, even when compiling comments for the working group and the board as well. And it will be possible for me to answer the questions and answers that are there. We try to, whenever time permits, we try to allow some people to put questions by opening up their mics and videos as well. But probably I need to apologize in advance, knowing that this standard is quite detailed, and knowing a lot of complex discussions will be coming up, inshallah. I'm afraid that we'll be taking only the questions that come in the Q&A tab. It will not be possible, given the limited time, to allow people to speak up. So our request is, please put all comments, all questions, concerns in the Q&A tab. Thank you very much. And with that, I'll share my screen. Okay, I hope you all can see my screen.
Yes, it's clear.
Okay, so now we move to the standard. The most of the things that are contained in the preface and introduction, I have briefed you already about it. So now I'll take you through the but one thing I think I should mention about the objectives that we want to achieve, but I think we can discuss that in the objectives part as well. So from that perspective, I'll just skip the introduction and preface part unless anybody has a comment on that. There is a comment by our respected brother Sadaqat. Assalamu alaikum, brother Sadaqat. Why speaker is not opening video? Please request him. I'm not sure, brother Sadaqat, that our videos and screen are clear to you now or not. But I think at our end, videos are on. So can you just confirm to me? Anybody confirm to me that video and screen sharing are working well?
It's fine for us, brother.
Okay. Brother Sadaqat, maybe you might need to check it at your end, but probably at our end it's working okay. Okay, so we in the chat window also some people confirm. Thank you very much. This standard aims to set out the principles for governance and management of investment accounts held with and other participatory investment instruments having a similar nature similar to IAs issued by the Islamic financial institutions. So primarily it is investment accounts, but any instrument which is in the nature of mudarba, musharaka, or other participatory arrangement, which is in this nature, shall be following this standard. Let me take you to the scope because a couple of things are important. But let's first complete the objective part. It's expected that the implementation of the good governance practices for IAs and other similar PIIs collectively referred to as in the standard unless the context suggests otherwise, through the adoption in the standard would help the Islamic finance industry achieve the following objectives. Improve the overall level of Sharia compliance in respect of IAs, improve the overall risk management mechanism for IAs, enhance the confidence of current and potential investment account holders. So the confidence of on the industry need to be enhanced, and eventually it will help in mutual sustainability and growth. And this is one thing where I would like to emphasize that we have received some initial comments that, oh, it is becoming very difficult and it will be costlier and it will impact the profits of the institutions. But we believe that this is towards better long-term future. And again, whenever we try to bring in any standard, we are always conscious of the cost. But one thing we try to consider is not only the short-term gains, but the long-term sustainability of and growth of the industry should be the priority for the standard setting rather than short-term gains. Safeguarding the reputation of Islamic finance industry, promoting better governance structures, and safeguarding the interest of the investor account holders, and promoting the practices of having high-risk investment accounts. On the scope part, this standard shall apply to investment accounts based on mudarba and similar contracts, including without limitation musharaka that represent quasi equity, including both the high-risk investment accounts and low-risk investment accounts, as well as investments placed by other financial institutions. So the treasury pools or the FI pools, etc., are also part of it. Wakala bil istismar arrangement commingled with unrestricted mudarba, they will be followed. Participants' investment account offered by the kaful institution, if the same is subject to classification, is a quasi-equity. This is a unique situation, but if it appears as a quasi-equity, then this will be applicable. Off-balance sheet assets under management, for example, restricted investment accounts and wakala bil istismar arrangements. So, musharaka, mudarba-based accounts, commingled wakala accounts, wakala bil istismar, and restricted investment accounts under off-balance sheet asset under management, they are all subject to this one. In case of takaful, having a quasi-equity instrument, it will still be applicable. Now, the next point is very important. This standard shall also be applicable insofar as suitable to the following: Sukuk or similar instruments based on participatory structure issued by an institution, whether or not being an IFI, in addition to the requirements of respective governance standard, that is GS12. So in case of Musharaka Sukuk, Mudarba Sukuk, Wakala Sukuk, with regard to the application of this one, the GS12 that is on Sukuk, that will apply, but because the underlying structure is Musharaka, Mudarba, or other participatory structure that is subject to the requirements of this one, it shall be applied. Similarly, the participants' investment fund, investment fund with of a takaful institution which is not classified as quasi-equity, that will also be subject to most of the requirements of this standard. Okay. Now coming to the definitions, I'll not read out all the definitions, but I'll just explain. Control is the accounting definition. We are talking about what should be on balance sheet and what should be off balance sheet. This issue is addressed more in detail on the accounting side here, since some of the aspects are there. So that's why we have kept this definition. I don't want to go into details of this definition. Demand investment accounts are the ones that are for without a time bound limit, so they are to be in cash on whenever demanded. They have some risks which are different from the time bound IAs. Then we have displaced commercial risk. Now this is something that I would like to mention because it has a very significant aspect to some of the requirements of this standard. Displaced commercial risk, DCR, refers to the extent of additional risk borne by an institution's owners in comparison to the situation where the IHs assume all commercial risk, including credit, market, equity investment risk, as well as rate of return risk associated with the underlying assets of the respective investment pool, considering the need to match their respective rates of return with the rate of return prevalent in the respective market, including avoidance of losses to be passed on to them. Sister Zara, just note my comment, a small comment about the language. I think instead of as well as, we should be using and here. Just make my own note for working group. Okay.
No problem.
So let me try to explain it, because again, we cannot have time to explain all the definitions, but this one has huge impact on the overall business model and this business structure. So what happens that when you go to an Islamic bank and invest your money, Islamic bank will invest that money through an investment pool in a portfolio of Sharia compliant investments. Those Sharia compliant investments or financings are subject to credit risk, market risk, equity investment risk, etc. These are effectively like as per Sharia, these are to be borne by the investor. Now, what happens that due to the market norms, if the return for the investor is up or down, and that here comes in the rate of return risk, that where all the commercial risk related to this are related to the investment account holder, so his return may be up and down every time. Now, if my return is more than the market, it is very good. I'll be happy. Maybe more people will start coming to this bank because this bank is giving more return. But if my return is less than the market, the people will try to run away. They will say, oh, our return is less here and we want to go to the other institutions. And this applies for Islamic versus conventional as well. Means that if the conventional bank is giving higher returns, a lot of people will say, okay, we are not concerned that much about Sharia. And on a lighter note, I remember one of the CEOs of an Islamic bank at times said that our people's faith actually goes with 50 basis points. It means that if we are 50 basis point, giving 50 basis point less return or charging 50 basis point more, that is 0.5%. So effectively, he said that our people will lose their faith. Again, I'm not justifying that there should be a difference. Islamic banks should be competitive and should be providing better service offering and better rates to their customers. but this is also a reality that there is a risk that customers will run away. Now, to avoid customers running away, the Islamic banks use profit smoothing techniques, including VR, IRR, and HIBA. We have discussed all these aspects in this standard. Again, we have discouraged HIBA because HIBA brings the transaction to close to a conventional transaction. Rather, we have promoted the concept of calculated and proper risk assessment-based reserves maintenance. So we believe that, but the problem is, irrespective of what model of profit smoothing you use, you need to consider the displaced commercial risk, which means that to some extent, the risk of the lesser returns will be coming on the bank, and the bank will end up paying like some HIBA or some compensation through a profit smoothing technique. And this is this is a very crucial risk, and the regulatory standards on this part and some of the regulatory requirements in different countries address it in different way. IFSB standards have addressed it in more detail. So we are not trying to overlap on the mandate of IFSB, which is on the regulatory and prudential standards. So we are not going to define what would be the impact of DCR on the capital maintenance. That is the mandate of IFSB, and that has been defined well in their standards. But from my perspective, from our perspective, my apologies, from our perspective, it is very important that we consider the impact of this DCR on the governance processes and the risk, obviously. So the risk factor changes, and again, a lot of governance practices have to respond to the risks. So you cannot segregate the governance and risk requirements. Technically, in most situations, you will have to keep the governance requirements responding to the risks, and obviously controls are also always management controls and the process controls. They are also to ensure that the risks are managed in the proper way. So they cannot be, they are always interrelated or corresponding to each other and cannot be segregated. And that is the reason that this displaced commercial risk has to play significant role in the governance suggestions that we have provided in this exposure draft, particularly with regard to low risk investment accounts. Now, okay, I think we have talked about high-risk investment accounts and low-risk investment accounts several times. So I think let's go to that definition also. It will be coming shortly. External Sharia audit, which is coming from other standards. Fiduciary capacity I mentioned, so let me just clarify it. The fiduciary capacity is the capacity to act in good faith on behalf of and for the benefit of another party with a duty to preserve trust. This is the definition, and this is what Islamic banks have to do. Islamic banks and financial institutions, and they have this requirement to act in good faith and on behalf of, for the benefit of another party with the duty of preserve trust. In this case, it is the investment account holders for whose behalf the banks have to work in good faith and have to preserve their trust. Let me quickly address this issue of HIBA also. HIBA is the voluntary act of payment of money or transfer of an asset to another party without a consideration. That is the classical text definition of HIBA. Now, coming to the explanation, in the specific context of the standard, HIBA generally refers to any amount voluntarily paid, transferred by an institution, normally out of its share of profit to IH as a gift to meet the desired level of return on IH's funds. However, the way HIBA is given can be different in different ways. So we'll discuss that thing later. Now coming to high-risk investment accounts. High-risk investment accounts, including such unrestricted investment accounts and most of the restricted investment accounts which do not meet the definition of low-risk investment account. So there is a definition of low-risk investment account. What does not mean it will normally go to high-risk investment accounts. But the restricted, it is generally understood that most of the restricted investment accounts are most of the restricted investment accounts are high risk. Sister Zahra, I just noted one thing. Just make a note of it for our discussion in the working group. I'm just thinking that most of the restricted investment accounts should appear before such investment accounts which do not meet the definition. So I think it will be better to present this way, but for the benefit of the audience today, I would like to mention that most restricted investment accounts, or probably all restricted investment accounts, would generally be classified as high risk investment accounts in this.
Okay.
Internal Sharia audit is the standard definition coming from other standards. Investment account is now this is an important definition. We need to clarify this one because there can be a different type of investment accounts which may not be called investment accounts in different regions or business or jurisdictions or in business models. So primarily, even in different countries, they are called participatory accounts, and they are called profit and loss saving accounts. So we know that in different markets they have different terms. And IFSB uses the term profit sharing investment accounts. So, but we have used the term investment accounts only. Our definition is IA is a participatory investment instrument commonly kept and operated as a banking account with an Islamic bank or similar financial institution. So this is investment account. But we said clearly in the beginning, as you recall, we discussed the objective and scope where we said that other participatory investment instruments also are in this. So if you have something called certificate of mudarba, certificate of musharaka, you have a trust, you have a term finance certificate on a participatory basis. So there can be different names and different structures and different instruments. In a nutshell, every instrument will be overall requirements will remain the same. So unless the context suggests otherwise, as we mentioned in the objective and scope, most of the things will apply similarly to all of these instruments. Another very important definition here is in the investment pool, which is coming from our financial accounting standards as well, because we have discussed it there as well. Investment pool in the specific context of the standard comprises distinct assets whose risks and rewards wholly or proportionately are attributable to the funding provided by respective investors within owner's equity, quasi-equity, and off-balance sheet assets under management of an institution. It's generally a virtual entity and at times a separate reporting entity. So the main part is that underlying assets, risk, and reward are pertaining to different sets of stakeholders. So these monies are kept in investment pool. Now, this is a virtual entity normally, but at times it can become a separate reporting entity as well in case of some regulatory requirements are there. But in a nutshell, an investment pool is defined in a way that whatever pertains to a set of stakeholders should be represented in form of a investment pool as a virtual entity. Which means that obviously you need to do the accounting and profit and loss computation, etc., for the investment pool. Investment risk reserve is also an important definition, which is mainly coming from our standard FAS 35. IRR, that is investment risk reserve, is the amount appropriated by RFI out of the investment income arising from the assets pertaining to relevant profit and loss taking investors in order to cushion against credit risk, market risk, and equity investment risk, mainly pertaining to residual future possible losses after impairment and credit losses accounted for in line with the requirements of AAOIFI FAS 30 for the respective stakeholders arising from respective assets and investments. Now, there are two types of reserves: investment risk reserve and profit equalization reserve. How they work, we'll come to that. Islamic financial institutions is a definition that we have kept in multiple standards. Just one thing I clarify every time, that all type of Islamic financial institutions are included in this definition, and the windows of the conventional institutions functioning on Islamic finance are also considered to be Islamic financial institutions. Now, low risk investment account again is a very important definition, and probably it's more important than high risk, because high risk definition says that what does not fall in a low risk definition will be the high risk. The low-risk investment accounts are the investment accounts offered to the investors at large with lower risk appetite and a safe-keeping mindset. When I go to an Islamic bank to keep my salary deposit or keep some saving invested, do I go there for a speculative loss risk and gain risk, or I go for safekeeping mindset? That is the point. Normally, a common depositor coming to a bank, even if it's an Islamic bank, in the back of the mind, he feels that it is a safekeeping place. I don't want to keep money under the pillow because it's not safe. And I want to keep it with the bank because it's safe. And obviously, it makes me easier to transfer and everything. But the safekeeping mindset is there. So the banking system, and that is the reason that on a personal note, I would say that my personal view is that the real objectives of Islamic economic system and Islamic financial system cannot be achieved primarily through Islamic banking, but these can be achieved through the Islamic capital market instruments, and more importantly, through the fintech and the new technologies and newer concepts that are coming up for the newer type of businesses. So the real concept of Islamic finance is business-oriented transactions, which are not primarily banking, and these are more on the capital market and fintech and other type of new instruments. In a nutshell, I would say here that if I go to an Islamic bank and in back of the mind I have safekeeping mindset, then I'm also ready that it will be low risk, less gain, less profit, and minimal risk of loss, or at least at times I think that there should be no loss. While in Islamic, there's always a risk of loss. So the common depositor and common investment account holder that comes to the bank is a low risk investment account holder. And those low risk investment account holders have primarily lower risk appetite and a safekeeping mindset. So LRIs include the low risk URIAs, low risk unrestricted investment accounts, and similar instruments considered to be quasi-equity, having put option and fixed maturity, and stable and low return expectations, with minimal risk of losses. This is the crux. The other characteristics include that these can be on demand immediately or within a suitable period or processing period, and subject to high liquidity and withdrawal risk. So mostly but these are not the primary characteristics, because it is also possible that some high risk investment accounts may also be on withdrawn on demand. Like for example, if you can have high risk mutual funds, but still you can withdraw your monies on demand. So that withdrawn on demand is an additional characteristic, but not a main condition. But the main condition is primarily these are quasi-equity and having stable and low return expectations. Management is a definition coming from our multiple standards. Monetary assets is a definition mainly used for transfer of asset purposes to make sure that Sharia compliance is there for transfer purposes, and the pool tangibility purposes. Mudarba is a profit-oriented participation between capital and work, and then we have the explanation for that. I will not go for detail. Off-balance sheet assets under management include assets held, managed, administered, or otherwise dealt with in an arrangement that gives an institution a fiduciary responsibility but not control. This is also coming from our accounting standard. Off-balance sheet participatory investment instruments, including investment account, is the broader definition, in which include off-balance sheet investment accounts. The main crux is that the control of the institution is not there. The definition of control is more like accounting issue, so I don't want to go into that detail. I think we now have few questions. Okay, I think we are reaching the end of the definition section, so just let me try to complete the definition section and then we'll handle the questions. I can see 5 questions raised by now, so I'll come to that. Off-balance sheet items include funds or assets. Again, I don't want to go in these details because today it's a long session. I don't want to read every definition. So on-balance sheet and off-balance sheet mainly is accounting classification, definitions coming mainly from accounting side. So I don't want to go into detail. However, this definition is very important. That's participatory investment instrument. The participatory investment instruments in the specific context of this standard include all instruments, particularly including investment accounts, whereby the investors are entitled to share, take the profit, and bear the risk of loss, and are entitled to a residual interest in the underlying asset or business, commonly referred to as investment pool, in line with Sharia principles and rules. These are normally based on mudaraba, but also include structures based on musharaka, al-wakala, bil-istismar, and certain hybrid structures. Participatory investment instrument may be divided into two main categories. First, where the institution controls the underlying assets, which are classified as quasi-equity instruments. The other, second, where the institution does not control the underlying assets and manages the same only in a fiduciary capacity, which are classified as off-balance sheet investment instruments. So this standard applies on all participatory investment instruments. But we have said that, that we have used commonly the investment accounts as the term because that is the primary and the substantial part of it. But as mentioned in the objective and the scope, that all participatory investment instruments which have the similar nature characteristic are part of it. This is the definition of participatory stakeholder, which is coming from the AAOIFI conceptual framework. This is the definition of a participatory structure coming from the accounting side. Let me clarify this one also. It's a type of contractual investment arrangement under which the investors are entitled to share, take the profit, and bear the risk of loss, and are entitled to a residual interest in the underlying asset or business. Profit and loss computation period. Now, this is an important definition unique to this standard. It is the period at the end of which the respective profits and losses of the respective investment pool are calculated, and liquidation, normally being constructive liquidation and attribution to profit and losses to its respective stakeholders, take place. Explanation: normally PLC periods is shortened than a financial reporting period of the institution, and in practice is normally a month or a quarter. In case of short duration investments, for example, a week, it may be limited to such period. Profit equalization reserve is the amount appropriated by an AAOIFI out of the income arising from the assets pertaining to profit and loss taking investors in order to maintain a certain level of return on investment for such stakeholders and the shareholders as applicable, and hence it's a tool for managing the rate of return risk, including the displaced commercial risk. Let me clarify two things. What is the difference between IRR and PR? IRR is taken out from the Rabbul Mal money only, not by the bank's money. PR is taking out from both monies. So PR is in the profit and loss computation, PR is taken before taking out the Mudarib return, while IRR is taken after taking out the Mudarib return out of the returns attributable to the investment account holders only. Now, this is the difference in how we compute it, how we apply it. But why does it apply? Because PR addresses the rate of return as a whole. And it is not for the investment losses. It is primarily, the primary purpose of keeping PR is to manage the rate volatility and the displaced commercial risk. Now, rate volatility is very significant in Islamic finance because rate of return risk of Islamic finance is more complicated than the interest rate risk of the conventional banks. Conventional banks have interest rate risk, which is part of the market risk, effectively that if the interest rates move in different directions, but they can manage both of them separately. In Islamic finance, you cannot manage both of them separately because the rate of return on the investment account of the pool, of the underlying assets of the pool, will impact the rate of return attributable to the investment account holders. And that is where at times the banks give hiba, but the recommended option is not to give hiba because it makes things similar or closer to conventional, the similarity becomes too much. Rather, we have recommended that a proper computation, risk assessment based computation based reserve should be maintained to manage the rate of return risk and also the displaced commercial risk. So PR is maintained to manage the rate of return risk and displaced commercial risk, while IRR is managed to maintain the risks of losses on the underlying asset. which are credit risk, market risk, and equity investment risk. Now, a lot of questions are coming up, actually, I can see, but let me try to quickly complete the definition section before taking it. Profit sharing ratios in the specific context of the standard include the ratios applicable to the working partner, that is the Mudarib share in case of a Mudarba contract, or the working partner share in case of a Musharaka contract, and to different classes of IAs, and where applicable to the other commingled funds in line with the requirements of the standard in a specific investment pool. Public interest institutions are the institutions. In a nutshell, let me define any institution that is a public interest. So generally it is if they have they are listed, or their securities like Sukuk are listed, or if they have retail institutions have at least 10,000 accounts. Unless differently defined by the respective regulator. So AOFI has recommended a large number as 10,000 as public interest institution, 10,000 accounts or 10,000 customers, 10,000 participants in case of takaful. But this definition is also contained already in our new Sharia governance standard. But in a nutshell, this we also allow the regulator a flexibility to define this part. But if the shares are listed, or if the other securities like Sukuk are listed and publicly traded, then it will remain a Islamic public interest institution. Quasi-equity, okay. I think for benefit of some participants, a lot of you, I can see your names and all that, and I understand that majority of you is understand the quasi-equity. We have discussed these things in our sessions, and our standards are already clarified this. But for those people who are new to the subject, we need to understand that what is the concept of quasi-equity. In Islamic finance, we believe that all structures cannot be divided into equity and liability like IFRS. We believe that there is a third classification also, and that third classification is quasi-equity. Now, quasi-equity is an element of financial statements that represents participatory contributions received by an institution on a profit sharing or participation basis. It has primary characteristics of equity because it's an underlying, and that is in case of loss, unless negligence, misconduct, breach of contractual terms if proved, the institution is not liable to return the lost funds to the fund providers, and the fund providers share the residual interest in the underlying assets of business. This is the primary characteristic of equity, but because we have a unique structure in which the underlying assets of the investment pool are pertaining to the participatory investment account holders, that is the reason that the primary characteristic of equity is met here. But it has a characteristic of a liability as well, that it has a maturity or a put option of redemption or liquidation. Under IFRS, anything that is a maturity or put option is kept into liability. So that is the reason that the institution that follow IFRS, they show investment account holders as a liability, which we believe is against the nature of these instruments as per Sharia. But you cannot put them in equity as well because they don't meet some of the criteria of the equity. So from that perspective, the classification as quasi-equity, or in some countries it was called redeemable capital as well. I personally believe these are interchangeable terms, redeemable capital or quasi-equity. Both are good terms, but AOFI here we use the term quasi-equity. In certain specific, and it also has certain specific features. For example, the right of the fund providers are limited only to the underlying asset of business and not to the whole of the institution, as well as they don't have certain rights associated only with the owners, like voting right, etc. Then we have a definition of reserve. I'll skip it. Restricted investment accounts are the investment accounts where the investment account holders, being fund providers, authorize the institution as Mudarib to invest the fund on the basis of Mudarba in a specific underlying asset or a specific investment pool of underlying assets, whereby the discretion of investment or financing decisions of the institution is limited. We have provided earlier the definition of restricted investment accounts was there in AOFI standard, but in this standard, we have provided some more guidance on this as to how to determine the restricted investment accounts. Sharia principles and rules is a definition according to a hierarchy mainly comprising of AOFI Sharia standards and others, which is already contained in other standards, and due to time limitations, I'll not go for that. The senior management definition also coming from other standards. It's a long list of definition. This standard itself is a huge standard actually in terms of details when you go. Tangibility requirements is very important about when you want to transfer the asset from one pool to another, what would be the tangibility requirements, and even within the investment pool, in order to make it permissible to do transactions in that, what would be the tangibility requirements. In the specific context of the standard are the requirements defined by an institution in line with Sharia principles and rules acceptable for the purpose of transfer of an asset or a bundle of assets, generally not being including debt, generally not being or including debt from an investment pool to another. This is actually, we have brought in one of the biggest Sharia non-compliances that are observed in Islamic financial institutions, is that at times they transfer debt from a pool to pool, which is a sale of debt, and they don't meet the requirements related to sale of debt. So I don't want to say that a lot of our Islamic financial institutions are doing haram. I'm not nobody to say that. But I can tell you that transferring a debt from one pool to another pool without following the Sharia principles and without applying the right values, that is the gross value of the receivable, is impermissible as per Sharia. And that, according to scholars, tantamount to riba. So honestly, this is one of the biggest non-compliances that we are trying to address through our accounting standard on the transfer of assets, and through this one. Obviously, the Sharia standard on Bay'ud-Dain is already there, but this is the practical issue that at times we see the Bay'ud-Dain requirement, sale of debt requirement with the outside parties, but we forget that we are doing similar transactions with the internal ones. And I would like to warn all of you that within your institutions or those regulators who are represented here in today's session, you need to find in the institutions under your jurisdiction that this has been one of the common practices which constitute a Sharia non-compliance. Those charged with governance is the term that we use for board and equivalent in line with the global standards. Time-bound IAs are the investment accounts which are on a time. Transfer of assets in the specific context of the standard is the transfer of assets from one investment pool to another, whether on balance sheet or off balance sheet, by way of either sale, exchange, investment clearing, or other. For example, if I line with contractual agreement, or through reconstitution of multiple investment pools. Now, this week said clearly that constitution of new pools is also for multiple investment pools in immediately following their constructive liquidation in line with the requirements of Sharia principles and rules. So this is a loose end that we are trying to cover through this part. Now, transfer of asset has two main Sharia issues. One is about transfer of debt, which is sale of debt. Second is bayina, that at time when asset is transferred from the pool and it returns back to the same pool with an understanding, because the other pool is already for a shorter period of time. So there is a bayina risk and there is a transfer sale of debt risk under the pool transfers. So these are the two main Sharia risks, but there are additional risks with regard to the fairness and equity and what value to be assigned when the assets are transferred from one pool to another, and whether it is fair and just and safeguarding the interest of the respective stakeholders of both ends. So this is something that has significant issues, and that's why we have covered it in our standard. Unrestricted investment accounts are the investment accounts that do not meet the definition of restricted investment account, which means that we have restricted investment accounts as we defined, and whatever is not restricted and meeting the definition of restricted investment account, even if you call it a restricted investment account. So, okay, you can name it a restricted investment account, but if it does not meet the criteria of restriction that is defined in this standard, so irrespective of the name, all investment accounts will fall in the URIA. With this type of account, the investment account holders authorizes an institution to invest the account holders fund in a manner with an institution deemed appropriate without laying down any restrictions as to Sister Zahra?
Yes,
without laying down any, I think the word any here, because we have used the term that it is not so the any significant restrictions, I think, or something like this need to be mentioned here. This any is not enough here. because there can be some restrictions, still it can be unrestricted investment accounts because it does not meet the meet the definition of restricted. So the word any here needs to be improved. Okay. Or we can refer it to that paragraph that actually, or a paragraph or section that addresses that issue. So as to where and how and for what purpose the fund should be invested. Under this arrangement, an institution can commingle the investment account holders fund with its own funds or with other funds of the Islamic Bank, has the right to use, for example, current account. The investment account holders and the institution generally share the returns on the investment fund. Sister, again here, we should say we are using the term institution, but in the third last line, we have used the term bank. Okay.
Yes, we have to make it consistent.
Yeah, make it consistent, please. Weightages. In the specific context of the standard, reflect the contractually agreed weights applied as per agreed profit and loss computation mechanism to the average balances of different investment accounts or classes of investment accounts within an investment pool for the purpose of profit attribution and distribution for a specific PLC profit and loss computation period, resulting in weight effect returns allocated to such IAs. The term weight, this weightage and weightage application is something very, very crucial. I think I have 14 questions now. I need to rush to them now. So number one, the first one is from Brother Naveedul Zafar. Assalamu alaikum, Brother Naveedul Zafar, and welcome to today's public hearing. By separate investment pool to be represented as separate reporting entity, brother, we said that it has to be a virtual reporting entity and not a separate reporting entity. Virtual entity, but not a separate reporting entity. But we said that at times these can be separate reporting entities as well. So there can be some restricted investment accounts, or there can be some, there can be an investment pool that reflects a participatory sukuk, a mudarba sukuk or a musharaka sukuk, which is tier 1 sukuk. According to FAS 34 of AAOIFI, the sukuk underlying assets are to be reported. So in that situation, that pool becomes a reported sukuk, reporting pool, a separately reported pool. So this is something that where we said that it's not always a separate reporting entity, but it is a virtual entity. So for internal reporting purposes, even for disclosure purposes in the AAOIFI's financial accounting standards on quasi-equity, for the reporting purposes, the significant pools and their underlying assets are to be disclosed as in a reasonable way. So from that perspective, some of them can become a separate reporting entity, but by default, separate accounting for each one of them is needed in the backend. So that's why we said that these all are virtual entities and you cannot mix up them. Thank you very much, brother, for your question. I hope it is clear. We have Kauthar Abdul Rahman. Can you explain about the ownership of investment risk reserve and profit equalization reserve? Does it belong to IAs or the bank? Excellent question. I think it was supposed to be addressed later, but maybe we'll not have time later. So let me just try to explain it right now. As I mentioned earlier, PER in the beginning is taken before segregating the Mudarib return, which means that the Mudarib return is also being used for creating PER. So it means that PER in proportion to the Mudarib ratio is owned by the bank, and PER in proportion of the investment account holder is owned by the investment account holder. So the PER portion related to investment account holders is to be shown as part of investment account holder quasi-equity, and the portion owned by the bank should be shown as a part of the bank's equity. That is PER. IRR, all of it pertains to the investment account holder fund and it should be kept as quasi-equity. Thank you very much. I think it was a very good question. And the same, your second part of your question is who has the claim over it in case of liquidation. So the same way that this will be applied. Brother Naveedul Zafar has added something to his question. By separate investment pool to be represented as separate reporting entities. So standard refers to creating separate subsidiary business unit within the Islamic Bank. Brother Naveedul Zafar, it is not the standard that is requiring. This is your contract and your pool creation that requires. So when you create two different pools, by default, by the Sharia and by contractual requirements, you are required to do internal accounting for two in a separate way. Profit and losses of one pool should not be mixed with the other. And it's not what we are requiring as a standard. We are simply saying that according to the Sharia principles and according to the contractual requirements that you have signed with those people, you need to keep it separate. So yes, standard clearly says that a virtual reporting entity means that you need to do accounting for them separately, but then accounting becomes more of a subject of our accounting standards. So the standard number 46, 47, they cover this thing, and 45, 46, 47, they cover these issues, including the transfer of assets in more detail. These standards were finalized last year. Their effective date is next year, but you can have access to them on our website. And I would always say that AOFI's standards are always a bouquet of services. So you need to read the Sharia standard and the accounting standard and the governance standard together to find what needs to be done in the overall context of investment accounts. Thank you very much, Brother Naveedul Zafar. We have my dear respected brother Wael Mirza. Assalamu alaikum and welcome, brother. As per paragraph 9 of the draft, especially about promoting the practice of HRIE that might not be suitable for banks, it is considered a part of their funding base, especially with Islamic banks, and the base should be more stable. Brother Wael Mirza, we should consider what is paramount, Sharia or the conventional banking practices. For me, Sharia is paramount. So we are not saying that the banks should stop doing LRIs. We are saying that low risk investment accounts might still be there. But what is closer to the Sharia? What is closer to the maqasid? What is closer to the Islamic economic system? Does Islamic banking exist only to mimic and replicate conventional banking? The unfortunate reality is the way low risk investment accounts are meant today, or all rather investment accounts are handled today, it is significantly mimicking the conventional, like some other products as well. So let's be honest. We want Sharia and maqasid and economic system of Islam as paramount, or we just want to create a caveat within the conventional system by just using a bunch of papers to make things Islamic. We need to opt between the two. And this is where we believe that while considering the real practical difficulties, we do not say that banks should stop offering LRIs. No, we still believe that LRIs will remain a huge and significant part of the banks, because this will be addressing the low risk appetite and the stability and the risk and the safekeeping mindset of the investors and low risk appetite for the investors. All these things will be addressed through low risk investment accounts. But even for low risk investment account, they shouldn't be just a mimicking of conventional. A proper back-end accounting, as I was answering to Brother Naveed, is a must. And this is the crux of this standard and our accounting standards, that this is not just a copy of conventional institutions. You have a different contract, and that contract requires that you follow some of the requirements. So yes, we are encouraging HRIs. We are not saying that all Islamic financial institutions must offer only HRIs. No, we don't believe that, and we are not in favor of it. But yes, we believe that HRIs should be promoted. Brother Wael Mirza, I don't want to go in that detail, but just would like to mention that one of the main reasons that people don't believe in Islamic banking being Islamic is they say that you don't share the things properly. If you have a loss is never passed on. And if you have a gain, you take all the gains and you just pass on peanuts to the investment account holders. And these are actual realities. But thank you very much, Brother Wael Mirza, for your reading of the standard, giving your comments, and being part of today's discussion. Thank you very much again. Brother Wael Mirza has another comment as per paragraph 11 of the draft. I think, Brother Wael Mirza, it will be better if I take your specific comments on specific paragraphs a bit later when we reach that paragraph, because you have read the whole standard, but maybe it will be some of the things would be not beneficial for the participants. So I'll try to take your question later. Brother Faisal Jafar has a point. Assalamu alaikum and welcome, brother. How you distinguish LRI with saving account by incorporating the safekeeping mindset in the definition of LRI? Brothers, normal saving accounts are always with the safekeeping mindset. The person that comes to the bank and he wants just a current account or a saving account, he has safekeeping mindset in the mind. If he had high returns in the mind, he might go for sukuk investment or he might go for mutual fund investment, etc. So from that perspective, we don't distinguish this. Rather, we believe that most of the saving accounts are LRIs. Thank you very much, Brother Faisal. Okay, another my very very dear brother Handamir, Mr. Sajeev, brother Handamir, Allah bless you. Thank you very much for joining in. So low risk urea are basically saving accounts, but what makes them low risk? Is it investing in fixed markup investments only? But because urea term deposit which have withdrawal restrictions, are they considered high risk, and why they are invested in different asset classes? Now, this is a question raised on the definition, so let me address it here, although some of the things may be addressed later. So first thing, brother Handamir, when you go to an Islamic bank and you deposit your salary amount there, or your bank directly transfers, your owner, your employer directly transfers your money to the bank account, and keeping a bank account there, what is in your mindset? You feel your money is safe there, am I right? It's in the back of the mind. We all believe that our money, even in Islamic bank, is safe. And obviously, we feel that yes, there can be a risk of loss, but that is a risk of loss like a conventional bank getting a failure. Without that, we don't feel that it is there. So when we keep money, we don't keep it under the pillow. We don't keep it with others. Giving a loan to a friend at times, you will feel it is risky, although it's a loan which he guarantees to pay back. While keeping an investment account with the Islamic bank, you feel more secure, that money is more secured, although the contractual risk of loss is there. So that is the first part, that it is the mindset part, that normal banking depositor, particularly the saving account and even the short-term DDRs, etc., they all come up with a mindset of safekeeping as well, and they want low risk, low return. They are not going for speculative returns. They want speculative return, they would go to stock market, to mutual funds, etc. They won't come to you. However, the second part of question is very important. Investing in fixed markup instruments only. No, it doesn't happen in only fixed markup instrument. Yes, but yes, majority is like that. So what happens that you invest in a portfolio of assets comprising of murabha, ijara, diminishing musharka, at times musharka, mudarba, istasna, salam. They all have different type of risks associated, but yes, to some extent, their returns are fixed or virtually fixed. For Murabha, it is fixed, but for others, it can be virtually fixed. And because of having a large portfolio and keeping appropriate provisions, you make sure that the risk of losses at any given point of time due to the credit market or equity investment risk doesn't become huge. And most of the Islamic banks, we understand that because of the low risk appetite of their investment account holders, they also don't go in any of the investment which high risk on the asset side. Now, Brother Handamir, let me take you to another angle. You are, very learned, more learned than me, mashallah. So you need to understand that if I invest, for example, in high risk assets, for example, a musharka asset, in the conventional banking regulations, the capital regime, I need to end up having high capital requirement. I don't want to do it. Most of the banks don't want to do it. So it by default, this banking system by default discourages going for mudarba, musharka, and other participating venture-based investments or other type of investments that are there, which are considered riskier from the banking perspective, but are important to promote the entrepreneurship and the economic development of the country and to achieve and reap the real benefits of Islamic finance. We just mimic and we just replicate the conventional banking. So now if you create high risk investment accounts and you have a clear mechanism of high risk investment accounts, particularly in form of restricted investment accounts, and you can establish that the risk appetite of these investment account holders is higher, and that risk appetite allows you to go for entrepreneurship and musharka, mudarba, participatory venture, and other, I won't say speculative, but other high risk, high return investments. That is what we want to promote. And I can tell you that fundamentally, keeping them segregated from this part and taking those parties taking the risk directly and your risk being limited to that, your capital requirements would go down on that part. And that situation will allow you to actually do that business without putting your own capital at stake, because the investor is willing to take it. Now, there can be different countries have different structures. Like some countries do not have a structure where we do not allow restricted investment accounts, etc. But still, then you can have an asset management subsidiary and create mutual funds, etc. for that purpose. That become a separate reporting entity as well. But the objective can be achieved through these means as well. On the other hand, we believe that only keeping Islamic banking limited to low risk investment accounts and low risk areas will not help us achieving the objectives of Islamic finance. And at AAOIFI's Governance and Ethics Board, we believe that we need to play our part in promoting the right practices of Islamic finance. So we encourage high risk area, high risk investment account, not only high risk area. We are promoting high risk investment accounts, means that most of them will be restricted investment accounts, but some of them can be high risk area as well. But the purpose is to promote the correct practices. I think brother Khandamir, I was able to respond to you, and probably I was able to actually answer about some of the questions that may come later. Now, the number of questions is increasing, and that is what is happening on this subject earlier as well. Probably even last time when we held the public hearings, it was like, that there were so many questions that we were unable to read the whole part of it. There is a question from anonymous attendee. Would displaced commercial risk apply in participatory instrument where the bank has no control over the asset, not quasi-equity or in restricted investment accounts? I think first thing, I always request all of the anonymous attendees to please kindly rename yourself so that we know you and we are able to record your comments with your names, because all these comments are actually taken to the working group. So we need, we request you to have your name, and even if with your institution name as well. So would displaced commercial risk apply in participatory instrument where bank has no control over the asset? Generally, the answer is no. Thank you very much. I think it is a good question. The answer is no. The purpose of having displaced commercial risk is where you have control on the asset and you have to some extent assume the responsibility of continuing this thing. So what happens? For example, you have a urea pool. In that urea pool, you have 100 million. Now, what happened? Out of 100 million, 20 million is yours and 80 million is investment account holders. Now, what happens that if you have less return on that pool and 20 million of the depositors run away, then it means that you need to insert additional 20 million capital by yourself, or you need to bring in some additional investment account holders with an expectation of higher return. So you will have to change your Mudarib share or other things in future, or you need to change the assets, but you cannot mature the assets as the customer run away. So displaced commercial risk is where your investment account holder runs away, but your asset has a maturity maybe after 3 years. So here you have the control on the asset, because you will have to fill in the gap by your own money. That money you need to bring in from some other sources. So effectively, there will be no commercial, this will be this situation of displaced commercial risk. Now, taking the other situation where you don't control it, we have gone to those details about how to determine control on that part in the accounting standard as well as here as well. In the accounting standard on control, FAS 45, you will find there is a table clarifying some of these situations. That situation, let me just clarify that if you have to fill in the gap, it means you control it. And in that situation, there will be displaced commercial risk. If you don't need to fill in that, it means you don't control it. There is no displaced commercial risk. Thank you very much. I think it was a very good question. I have tried to be very brief on this answer, but this requires maybe an hour of discussion. So I just tried to summarize it in a very short way. I think we have some of the things coming on the chat window as well. So my request again is anybody who has put any comments on the chat window, please put them on the question and answer tab. Okay, Brother Hundamir again. So when we allocate IRR, we can take from investors' profit. Now credit losses and impairment are deducted from the shareholder profit, also from the urea profit. Let me ask, okay, and it from urea profit only stage 3 or all stage 3? This is also governance question because it relates to fairness towards the urea investor. Excellent question, Brother Hundamir. Allah bless you. Always you know put some good things. For us, I think we are clear on this part that IRR is taken from the investor profit to the extent of their proportion. So the point is, if in the investment pool there is 20% of the owner equity and 80% of the investment account holder equity, then IRR should be either taken from investment account holder 80% only, or if it is taken from 100%, then owner's equity is also involved. This is the situation that we generally believe that that normally it will be only investment account holder fund. Sister Zahra, I think this comment is very important. We need to clarify probably this part a bit better way in the standard. The point is clear. Secondly, Brother Hundamir, about stage 3 part, we believe that the definition of IRR that we have put in here and in FAS 35, this definition is coming from FAS 35. First, you have to apply provisions, then IRR. So earlier AOIFI was keeping IRR a bit open. Now IRR is more clear. There is a table in the there are tables in the FAS 35 which we have reproduced in this standard about also how to calculate IRR and PER. Let me just take you to that one, like very quickly. I think because some of the things we cannot discuss in detail maybe, so let me try to do very quick on that part. Now it is the table. Sister Zahra, I think last time I requested the table should be on one page. Now I need to open the table on the PDF window. It was not corrected. Please make a note of it that tables, etc., should be on the same page. So I need to stop sharing from here and I'll share from the PDF version.
Okay.
This part of PER, the appendix on PER, Brother Hundamir, can you see this screen? All of you, Sister Zara, confirm please.
Yes, brother, we can see.
Okay. PER maintained in line with the requirement of this standard for each category of stakeholders shall be considered adequate if it is sufficient to absorb the combined monetary effect of the rate of return risk and displaced commercial risk applicable to such category of stakeholders. This combined monetary effect shall be calculated according to the respective accounting policies of the AAOIFI. Sample computation approach is provided in Table A. Such policy should be developed according to the best practices of risk management and shall reflect a prudent approach. So now this is Table A. Okay, Brother Hundamir, if you see that how to calculate PER, the best estimate of maximum impact of rate of return risk, that is change in average rate of return risk on asset side. Then the second is on investment account side. So their asset, for example, the asset rate of return risk goes 1% down and the rate of return that you need to provide to the investment account holders goes 1% up. So you will have to add both impacts. Additional impact of displaced commercial risk, including where applicable liquidity consideration. So even the displaced commercial risk has liquidity aspect also. So from that perspective, you need to calculate this. Again, we have not put in the computation methodology herein, which will be according to your risk management practices. Now, this comes to the total possible impact. Then the expected level of absorption of A by IRR, because A is on the asset side, so some part of A will be addressed by IRR. So we'll come to IRR calculation next. Then expected level of absorption of IRR by amounts of allowances of credit losses, impairment, NRV adjustments, and provisions developed in line with FAS 30. And then total expected possible impact nullified by E and F. And then D minus G will become, so A, B, C is positive, C, E and F are other cushions that are available. And then you come to the net appropriate level of PR. And then you will decide that this level of PR that needs to be maintained will be developed over a period of time. So you calculate a monthly contribution that will be taken out to reach that level of PR over a period of time. So you define according to your transfer policy that how much the period of when you define it. Now coming to IRR, IRR maintained in line with the requirement of the standard for each category of stakeholders shall be considered adequate if it is sufficient to absorb the combined monetary effect of credit risk, market risk, and equity investment risk applicable to such category of stakeholders. This combined monetary effect shall be calculated according to respective accounting policies of IFIs. A sample computation approach is provided in Table B. Such policies shall be developed according to best practices of risk management and on a prudent approach basis. Now we come to the Table B for IRR. Now, if you see the best estimate of the maximum impact of the credit risk, best estimate of maximum. Now, this is the maximum impact. Now, please keep in mind that FAS 30 requirement or IFRS 9 requirement is the best case scenario, the reasonable estimate. It's not the worst case scenario. But when we say the maximum impact is the worst case scenario. So here we are talking about that while FAS 30 provisions, that is stage 1, stage 2, stage 3, would be sufficient in normal cases. But what happens in the worst case scenario is over and above the credit risk, over and above the FAS 30 requirements. So the requirement of credit risk under A, basis of market risk under B, basis of equity investment risk under C. So this is the total impact. Then a level of absorption of D by overall provisions that you keep under FAS 30. So that takes you to the appropriate level of IRR. Which means that the IRR maintenance requirement as per AAOIFI is after maintaining the reasonable estimates of losses are as per FAS 30 or IFRS 9. And the worst case scenario, difference between worst case scenario and the normal expected losses under FAS 30, that difference goes to IRR. That is over and above the provisions. So now I think, Brother Hondamir, your question stands clear. I hope so. Now let me share the presentation again. Still, we have large number of questions. We have now number of questions is actually increasing every time. When I answer one question, in the meanwhile, I get 2 more questions. But this is good. Again, anonymous attendee, again, we request you to rename yourself kindly. Does it mean that assets under IH is exposed to the rate of return risk and also interest rate risk? No, not interest rate risk. We don't believe that interest rate risk, again, you want to say that market interest rate risk is impacting that. For us, that might be correct to some extent, but again, we are not subject to interest rate. But I would say the benchmark rate. If you have used the term benchmark rate here, then my answer is yes. But if you say interest rate, that there can be an argument that okay, it's a peer pressure or a displaced commercial risk can be subject to that. But assets are not subject to displaced commercial risk. Assets are subject to benchmark rate changes. That is correct. So from in a nutshell, the benchmark rate will be impacting it. That is correct. Thank you very much. Okay. Another question from anonymous attendee. Anyone? At time we don't know whether it's the same anonymous attendee or somebody else. So anyway, again, there is a question that PR is not to cover losses. Is it to manage and it is to manage the rate of return risk, how it is different? The point is that primarily to cover losses is the provision, which is maintained under FAS 30 or FRS 9 and in different markets. According to AAOIFI, it's FAS 30 provision, that is impairment, credit losses, etc. On risk commitments also. Then, so this is the minimum. This is the normal estimate or best estimate of the expected losses. Then there is a worst case scenario. So we are saying that the worst case scenario should be maintained under IRR over a period of time. So if you maintain IRR and provisions under FAS 30 properly, it means that risk of loss for the assets is fully covered. Then do you need PR? Probably then you don't need PR. But we need PR because at times it is not the issue of the losses that will be happening, but rather it is the issue that the rate volatility will impact the returns that I need to pass on, and hence I will have a problem. Now, the banks make a simple approach of giving hiba. But what happens if the profits are more? So what happens that it's a better approach to keep PR, that when the profits are higher, you keep reserves, and when the profits are lower, you pass them on to the investment account holders. So the rate volatility and the displaced commercial risk, where there is a risk that the customers will run away because they have a lesser rate of return, these are the risks which are managed through PR. So if you have proper provisions under FAS 30 and proper provisions, proper IRR available, then losses will not be there. Losses will be covered out of that. You don't need PR. The need for PR is for rate of return risk and displaced commercial risk over and above what you maintain as IRR and provisions. Thank you very much. So in our approach, in a nutshell again, first, to cover your losses, you need to have provisions and impairment and credit losses. Then, to cover the worst case scenario, you need to have IRR. Then, in order to address the risk of rate volatility and risk of customers running away because of rate volatility, you have PR. Thank you very much. Okay, we have a comment from Nuhu Idris. Assalamu alaikum, walaikum assalam. A prominent Islamic scholar in Nigeria once said that Islamic finance and conventional finance are just the same, it's just a trick. I vehemently disagreed with him at that point of time. Unfortunately, I'm tending to believe in this assertion when I recently came across a section of your Sharia standard on Mudarba profit sharing, when it is stated, your question is not complete. I stated Sharia standard 40, when one of the two parties stipulate a lump sum amount for himself or Mudarba becomes null and void. This section, however, does not include the case when two parties agree if the profit exceeds certain limit or index, the excess amount should be taken by one of them, meaning that the institutions are allowed to fix the rate of return for their investors. Kindly clarify. Okay. So now the point that you are having is, again, I think we need to clarify. It's an important point. So first thing, what is written in the Sharia standard, we believe as AAOIFI is absolutely correct, and this is in line with Sharia principles not defined today. Sharia principles are coming from the times of the revelation of Holy Quran and Nabi Karim Sallallahu Alaihi Wasallam. So you know that the Sharia says that Muslims, the Quran says that Muslims are according to their contracts, and it says that don't take each other's money through the wrong way, except for it is a trade transaction between you with mutual consent. So with mutual consent, having a dual tier or three-tier model of profit distribution with mutual consent is perfectly all right. Although the view is that some of the scholars have a view that this should be more fair and just. To that extent, we have tried to cover these things on the governance side as a good practice. But what is minimum requirement of Sharia, that is perfectly all right. So okay, forget about bank. We want to do a business. I said to you that, okay, you invest with me, my expected rate of return is 15%. And if rate of return comes more than 15%, our profit sharing will be done in a way that first 15%, to the extent of first 15%, we will share equally. So I get 15%. And over and above the 15%, we will share in a way that you get the 100% or 99% or 95%, or we can create two tiers, or we can say that over and above the 15% will go to a profit equalization reserve, and it will be used next time if the profit is less than 15%. So all these models, which are according to the mutual agreement, without guaranteeing the capital and without fixing the profit for parties, it is permissible. These are, yes, these are the caveats, but these are the caveats which apply for the practicality of the transactions. If you say, no, every time everybody should share 50-50, no, I'm sorry, this will not work. This cannot work. You say that everybody should be having absolutely equal weightage of profit distribution. I'm sorry, but there are different factors determining the pricing of the transactions. And I can tell you that Sharia has kept the pricing of the transaction in line with the Quranic teaching that I mentioned just now. Sharia keeps pricing in the hand of Muslims according to their contract. And that would be the reason that you see in our standard that we always say that this should be done according to the Sharia requirements as well as contractual obligations. I was just checking because I think we need to take a break as well. It is 11:47. The prayer time in Bahrain has started. We can take a break just now for just 13 to 15 minutes to just stretch our legs. Anybody who want to have a cup of coffee, and we need to pray as well. So we'll be joining back by one. We'll keep a very short break, so 12 to 15 minutes only. So we'll join back at one or one. We'll try to join back by one, inshallah. Oh, sorry, 12. My apologies. 12. That is 10 to 12 minutes break only for prayers. Okay. So here, I hope that all of you will continue. It's just a short break to stretch our legs and to pray. Assalamu alaikum, everybody.
وعليكم السلام ورحمة الله.
I think we should start. Let's continue the discussion on the questions first before going back to the presentation. So this question I responded in general, the last one about the rate, you know, what we call the ceiling, the rate ceiling or tiered profits. So we believe that these are all, like, you know, again, whatever is in the Sharia standard is all based on the Sharia permissibilities. And, you know, at times, justice and equity does not mean that everybody gets equal amount or something like this. Justice and equity at times depends on, like, you know, at times the working partner deserves more. Just to clarify one more thing, it just came to my mind now that that Sharia has another condition that the dormant partner cannot have a share more than the proportionate share of the working partner. This is just to make sure that the capitalist does not exploit the working partner or the entrepreneur. This condition still applies even under the Sharia standard of AAOIFI. So you should just keep in mind that this ceiling can work in the favor of the working partner and not in the favor of the capital provider, because Sharia has this thing that capital provider cannot have beyond that limit. The next comment is from brother Wail Mirza. Brother Wail has a comment on the definition of the Sharia audit, internal Sharia audit. He has a comment on that it should add the management as per, well, based on the internal Sharia audit standard. Sister Zahra, just make a note of this point and we'll try to match the definition, and we'll make sure that if we missed out something. Thank you, Brother Wail Mirza, very much. Then we have comment from our dear brother Sadaqat. Assalamu alaikum and walaikum assalam. Low risk investment accounts, LRIAs, generally IFIs are not mentioning about investment deposit product, that whether it's low risk investment or high risk. Ideally, there should be a clear disclosure towards the type, nature, low risk, high risk associated. Yes, sir. I think you are to the point, fully agreed with your comment. Actually, this is a requirement on the initial disclosure, the risk appetite. We have asked for the risk appetite, but Sister Zahra just will make sure that although I'm 100% sure that we have asked for the risk appetite, but have we clarified about low risk or high risk or not? Actually, we have put requirements of low risk and high risk separately in different sections. From our perspective, it's required already. But we'll just make sure that your comment is appropriately addressed. Thank you very much, Brother Sadaqat. We have Brother Wail Mirza again. General suggestion, it might be good to add in standard about prudential requirements where PSIA funds, where PSI funds and any associated reserve accounts, PR and IRR, are prohibited from being included in the calculation of the bank's regulatory capital. Brother Wail Mirza, first thing is we don't do the prudential regulatory standards. That is the domain of IFSB. So we probably will not write anything like this in the governance standard. However, the PR, the proportion of PR that pertains to the to the shareholders or the institution, that can be added to the regulatory capital, sir. I think IFSB also allow it, if I'm not mistaken. But from our perspective, that can be part of equity because that is the proportion that relates to that part. But it should not. It should reduce. It should reduce the net risk, because when you calculate the risk and then you know that there is a risk cushion available, so this PR and IRR should be reducing that risk part. But then only PR related to the investment to the shareholders, that can be considered for the regulatory capital as well. But again, what I'm saying is based on my understanding as a student of Islamic finance, and as AAOIFI, we do not overlap with the domain of IFSB. So here we will not be writing anything on that part. Thank you very much, Brother Wail Mirza. We have comment from Daniar Mamirov. How is profit distribution formula itself look like for Mudarba deposit? Why it is no standard in this procedure? Some risk weight 1 year Mudarba and are are 1, sometimes 1.2. Second question is, what is the essence of point system in deposit profit distribution? So first thing is about the risk weights. We don't call it risk weight, we call it weightages, because it's not specific to risk, rather it's according to the profit computation. So yes, we have put in some restrictions on the respective section in this one, where we have said that the proportion of the lowest weightage versus the maximum weightage should be controlled. And we have put such suggested numbers, and we have said that this should be subject to regulatory adjustment, but this is our, like, regulator can define it differently, but we have defined it in the standard at 1:2.5. Overall, that section is very important, brother. This is very important that you need to understand here, that this calculation of weightages is very complicated. I agree. The point, again, I'm not clear about the point system. Point system is the way of calculating, but the way you are, because the different banks are doing it in different ways. So you are talking about point system in the meaning of the different weightages being assigned to that. For that, I think we have actually given some situations where some of the different weights can be justified and where some different weights cannot be justified. It is all written in the standard. Probably, I hope that we reach that point that we are able to answer to you. I'm not sure whether I have been able to answer all your question here, but I believe that once you read the relevant section, we can have that discussion again on a specific paragraph number basis. Thank you very much. And my apologies if I am not very clear on this point, because even the question, particularly the second part of the question, was not very clear to me. Kauthar Abdurrahman has another point. Thank you for answering my question. I want to ask further, and a bank can include PRIR in their capital requirement to address credit risk capital requirement of the IH or the DCR. Actually, just now I responded to Brother Handamir on this point, so I think your question is addressed. If any point is not addressed properly, then that you can put again in the questions. Brother Ahmed Antile, welcome to today public hearing, all of you. Then let us raise my question. Who are the contributors of quasi-equity contribution received by the institution? All the investment account holders or the depositors who deposit on a PLS, profit and loss sharing basis, they are the capital contributors, the quasi-equity contributors. In case of quasi-equity sukuk like Musharaka Mudarba sukuk, the sukuk holders are the contributors. Brother, while Mirza has another general suggestion, it might be good to add something about product awareness, where IH would be awarded about risk of loss which cannot be recovered by the bank, except in some cases such as negligence, misconduct, etc. Brother Weil, thank you very much for your suggestion. I would be requesting you, because we have sections related to account opening form, where we have report requirements on the transparency and disclosure at the time of contract and account opening. We have put transparency and disclosure requirements on a general basis. So probably what you are mentioning is covered there. However, if you want to make a more specific point, Brother Weil, we would be highly obliged if you can just make a specific comment on those sections, that where we have missed this general product awareness part, because we have put in quite a lot and quite detailed requirements for the transparency and disclosure about it. Question again from Daniel Mamirov. If bank wants to increase Mudarba deposit term from 2 to 3 year up to 5 year deposit, should also give new risk weights? Yeah, that is a good point. Okay, we have said that. Let me just take you to this point, because okay, this is the section 30, because a couple of questions are related to this one. So let me consider this paragraph 30. Determination of PSRs and weightages for distribution of profit. Sorry, 29 is also this whole section. I think I need to read out this one, 29 onwards. An institution shall at a minimum consider the following factors for determination of PSRs and weightages. The PSRs, including the Mudarif share and the weightages applicable to IAs and the owner's equity. The weightages, it is not risk weight, it's weightage. Because it's not linked to risk, rather it is linked to the return. The PSR, including Mudarif share and the weightages applicable to IAs and the owner's equity where applicable, shall be based on a fair and equitable approach towards distribution of profit based on average balances. See paragraph 39. That is more about competition. Net losses, if any, attributable to an investment pool shall be allocated disregarding the PSR and weightages based on average balances of the IAs and the owner's equity. Determination of PSRs may take into consideration the following subject to other requirements of this standard. Any regulatory requirements and limits with regard to the determination of PSRs, expected yield of the underlying asset of the investment pool, a relevant, preferably Sharia compliant benchmark rate applicable to the equivalent investment assets, indirect expenses or operational costs incurred by the institution in managing the IAs in the respective investment pool, and any other rational or objective parameters factors resulting in a fair and equitable treatments amongst different stakeholders. Once determined for a PLC period, the PSR should not be changed unilaterally. Sister Zahra, there is I think there is a numbering issue here. Sorry. Okay, no, it's okay.
Yeah.
Once determined for a PLC period, the PSRs and weightages should not be changed unilaterally. Any change to a subsequent PLC period in respect of PSRs and weightages should take place before the beginning of such PLC period, subject to requirements of paragraph 83, which are related to transparency and disclosure. Now, determination and allocation of different weightages or where applicable PSRs to different classes of IAs within an investment pool shall be subject to the following consideration. An institution shall maintain a suitable range ratio between minimum and maximum weightage for each investment pool in line with the relevant regulatory requirements. In case of LRIAs, the maximum weightage applied to a case of IAs shall not be in excess of 2.5 times of the minimum weightage applied to any other class of IAs unless a stricter requirement is imposed by the respective RSA or is self-imposed by the institution itself as a policy matter. The weightages, as far as practical, shall be denominated in easily understood numbers, for example, 1 to 2.5, or in terms of percentage, 100 to 250%, to make them more understandable to the stakeholder. The difference in weightage within the same investment pool shall be justified only in and to the extent as justified under either of the following situation. A higher weightage to a class of IAs with a longer investment period or the element of profit payments at maturity or at longer intervals. So this is because we were having multiple questions on this area, so I just wanted to cover this whole. This particularly, so we talked about the ratios, minimum and maximum ratio limit should be there. They should be understandable, clearly disclosed before beginning of the period. Then we are saying that higher weightage to the class of asset with longer investment period. So if you have 1 year investment versus 5 year investment, so you can give higher ratio or higher weightage to the 5 year investment, or to the element of profit payments at maturity or at longer intervals, commensurate with the benefit to the institution and then the greater interest of all stakeholders by way of management of liquidity risk, decreased operational risk, ability of institution to take risk on long-term underlying assets, etc. So we are saying that the long-term investment deposits have lesser management risk. They help you in managing the liquidity risk. They are at times in greater interest of all stakeholders through decreased operational cost and ability of the institution to take risk on long-term underlying asset, etc. So we are saying the higher weightage can be given to IAs with longer investment periods or longer profit distribution elements. Reasonably, but not significantly higher weightage. This is a very important point where we said that a reasonably higher weightage can be given, but not very significantly higher weightage can be given to a class of IAs with higher average amount of investment as compared to other IAs. So somebody invested 1 BD and somebody invested 1000 BD and somebody invested 1 million BD. We said that they can have a slightly higher weightage, reasonably higher weightage, but not significantly higher weightage. Now, this should commensurate with the benefit to the institution and in the greatest interest of all stakeholders by way of reduced operational cost. Because when you have higher amounts of deposit, your operational cost per unit of investment is reduced, and accordingly, it may be justified to give a higher weightage to some of the investors depending on the higher rates. A reasonably but not significantly higher weightage to a class of IAs due to social and environmental but not commercial considerations. This may include, for example, highs held by widows, orphans, senior citizens, WAF, charitable organization, in line with the overall sustainable finance strategy of the institution. So you can also provide some social aspect based higher returns. So it can be again reasonably but not significantly higher weightage. So OFAF, NGOs, senior citizens, orphans, widows, they all can get like, a bit higher rate of return depending on a slightly higher weightage. An institution shall apply the following consideration to the Mudarib share applicable to each investment pool. Mudarib share shall not be variable. It must be fixed and disclosed before the commencement of a PLC period. Sister Zahra, I think it should not be a semicolon here. Either we make 2 points, just make a note of it. We have to slightly correct it. Any voluntary deduction in Mudarib share during after completion of a PLC period applied as a profit smoothing technique shall be subject to the requirements related to HEBA. So now we go back to where we were and we just try to address remaining some of the questions that we have received in between. And then we'll continue with the presentation, on which I'm just getting afraid. I'm already afraid that the time for that is not sufficient, unfortunately. Even in the first public hearing, I believe that the time was not enough. We have a comment from Miftahu Dibaba. How can IFIs effectively balance their fiduciary duties to IH with the need to generate profit for their own stakeholders? What are the potential conflict of interest that might arise and how these can be mitigated? To be honest, I don't have any one single answer to this one, because the whole standard of so many 70 pages or odd pages or something is written to address this thing, to be honest. Yeah, like, to address Sharia compliance and this part, there is no single thing. It's about fixing the weightages. It's about giving the priority of funding. It is about being fair and transparent. It is about passing on the losses versus, it's about Sharia compliance. So many things are there. And to be honest, this whole standard is an answer to that. So honestly, I may not be able to answer this question very clearly. Brother Naveedul Zafar again, we witnessed some profit rates offered by IFIs as that of conventional bank. What they are seeing when Mudarba accounts have all different way of earning profit. Brother Naveedul Zafar, the point is that that rate being close to, first thing is it is not the profit rate offered. It is the weightage and the product that is offered according to the the mechanism. So what Islamic banks say is the expected rate of return. Yes, we know that currently Islamic banks try to mimic the conventional to a significant extent, so they will try to match the rates. But at times, I can tell you it's not the case. So I'm aware that in certain jurisdictions, the returns by Islamic financial institutions are less, including Pakistan, including even in Bahrain. I think at times Islamic banks give lesser return. There are certain other markets where. So let's try to understand one thing. All over the world, Islamic banks normally are liability heavy or deposit heavy and have excess liquidity in most of the markets. This is the reality of Islamic finance across globe, because a common man normally come to make deposit with Islamic banks. So their average cost of fund is less than conventional. This is the reality, except for some struggling Islamic banks who are trying to offer higher rates of return to some of the high net worth individuals and the corporates and the governments. Other than that, I can tell you that on a general basis, in almost all the jurisdictions where we can see Islamic finance has less assets and more deposits. And this is a constant issue. So in a lot of markets, we see that Islamic bank rates are less. It shouldn't be the case. It should be higher. But yes, as of now, it is justified because of this thing. Secondly, the rate of return of the Islamic banking investment pools on the asset side is also linked to more or less the same benchmarks, because right now we are not having ideal Islamic economic systems. If you have ideal Islamic economic systems where conventional banking does not exist, there you can have better solutions. But where most of the markets where we have Islamic banking being the smaller part of the conventional market, in that situation, at times your rate of return on the asset is also impacted by that. The third answer to your question is actually this is exactly the displaced commercial risk, that because banks don't want the customers to run away, and that is the reason that they try to match their returns with the conventional ones. So this is a summary question to your summary answer to your question, although it may need a PhD thesis to be written on that part. But I try to just be quick on answering your question. We have again another question from Miftahu Dibaba. The document mentions different types of investment accounts, including high risk and low risk. How does an Islamic financial institution determine the appropriate level of the investment account? What are the specific risk management strategies employed for high risk investment account? How these are communicated to IH? Again, my dear brother, I think you need to read the standard. And for me, first thing I would like to answer that high risk and low risk are not classified by yourself, but rather it depends on your own strategy as to what type of investment accounts you want to offer. Most of the Islamic banks across the globe right now are offering only low risk investment accounts. So by default, almost all bank accounts as of now, and at least 90-95% of them are low risk. The high risk accounts, one of the examples is that Malaysia started offering the high risk accounts. They don't call it high risk account, but they eliminated some of the controversial practices of the Islamic banking from the investment accounts. So some of the Malaysian practices, we say that they are close to the high risk. Although the negative part was that because they did not allow the low risk accounts like we are allowing. So the result was that a lot of people moved to the Tawarruk based accounts, which we, according to AAOIFI Sharia standard, are not allowed, not preferred and not allowed. May not be termed haram, but not preferred and not allowed. So from that perspective, we gave it a thought, and we were very conscious about it, that if we insist that only high risk accounts should be there and only all the controversial and mimicking practices should be removed from here, what will actually happen is that people will revert to the Tawarruk based accounts, because the need of safekeeping mindset and low return mindset, low risk, low return mindset would still be there. So from that perspective, we distinguish. So this is the point that Malaysian regulator did a very, very good effort, highly commendable effort to improve the quality of investment accounts from Sharia perspective. And they came up with something that is closer to high risk account, what we are calling as. But the negative part, what happened, that people reverted to because of the low risk mindset and the high and the safekeeping mindset, people reverted to the Tawarruk based accounts, which should not have been the case. We believe that low risk investment accounts are better than Tawarruk, to be honest. Only you need to follow the Sharia conditions which are there. They are much better than Tawarruk in all cases. So from that perspective, we preferred to make two categories of investment accounts. So when we were developing the standard, one approach at the governance board level was, and the working level was, that we come up with the ideal requirements, which will make it all high risk. But the other risk was that people will run away. And that was the reason that we tried to find a middle ground. We are not living in an ideal Islamic economy. We are not living in an ideal Sharia compliant world. We know that we have to live with the realities of life, where Islamic finance is trying to find Sharia compliant solutions for the Muslim Sharia conscious users within the parameters which are not defined primarily by Sharia, but are defined by the conventional systems and the conventional laws. So from that perspective, this is our preferred approach, that instead of going to Tawarruk based deposits, which we don't allow, you should be dividing your deposits in two parts, high risk and low risk. And eventually we want, if the Islamic economic system is there, if the things evolve in the right way, we would like to have more and more of the high risk investment accounts. Brother, there is a comment from brother Abdullahi Ashur. Salam alaikum assalam. He's from Somalia, and my dear brother, most welcome. I have MBA of Islamic banking. It's a very interesting topic, and would like to get slides through this email. Brother Abdullahi Ashur, the slides we don't share, but the slides are exactly the representation of the PDF version of the standard, which is already available on the website. And in the chat window, our team has provided a link to that one. So you can always download the PDF version, but the slides, unfortunately, we don't share. Thank you very much, brother. There is another comment from anonymous attendee. In case the bank is acting as an agent, on what basis would it to cover loss? Isn't the principal primarily liable for losses, even in such cases, or losses are related to the performance by the agent of its role? Agreed, 100% agreed, no disagreement to this part. now there are two different situations. One is about Mudarib and one is about Wakala. We believe that in Wakala, it shouldn't happen at all. And we believe Wakala should generally go for high risk, although technical people are putting it in low risk. So yes, we don't have any disagreement with what you said as per Sharia. Now the question is that if it is not required by contract, it's not required by law, but our agent wants to avoid the displaced commercial risk and doesn't want the customers to run away and makes up compensation out of his own, would it be haram? I would say it is not preferred, but it would not be haram if it is unilateral thing. So I think for Mudarib, it is more easily conceivable, easily understandable. But with regard to agent and principal, if you ask me the ideal environment, the problem is we don't live in the ideal environment. This is very unfortunate that even in the Muslim countries, the conventional banking is predominant. Even in the Muslim countries, Sharia is not the law of the land. In most of the Muslim countries, for the commercial law, for the business law, for the overall system. So again, the problem is that Islam is a complete deen. Islam provides guidance for every way of life. You cannot pick and choose. You cannot say, oh, I'll pick this one and I'll not pick that one. And that is where we are stuck, because we are trying to find a Sharia compliant banking solution within a banking universe which is not Sharia compliant, within a financial universe, within an economic system which is not Sharia compliant. So at times there are trade-offs here because of displaced commercial risk. So in a nutshell, yes, you are absolutely right. This is correct, and that's why we are trying to promote the high-risk investment accounts where this will happen, where hiba, etc. will not be there. But still, profit smoothing techniques through PER and IRR, we still prefer and we promote them. We are saying there should be no hiba, only PER and IRR should be there. We believe that PRR and IRR, if they are computed in a proper manner and developed over a time or in a proper manner, they would be more appropriate. So let's move to the next question. Brother Mufti Khwaja Nurul Hassan, Assalamu alaikum. Though it's not directly related to the discussion, however, you are aware the global profit distribution mechanism, including Pakistan regulatory restriction about profit distribution 2012 and others. So what are you use that those instruction of profit pool management, especially we focus on 2012 instructions. It is aligned as per AAOIFI standard, including the maintenance general pool special mechanism. Any additional point that may be required for further clarity in them or conversion in the process. So first thing, we reviewed multiple regulations in different countries, and we found that 2012 regulations of Pakistan were good. Malaysian regulations are good. Now, we learned from different experience of different regulators from that perspective. Our main consultant, brother is Muhammad Islam Ahmed, who also was in the opening remarks. He was also part of those 2012 team that worked on those 2012 instructions in Pakistan, and that was one of the reasons that he had the relevant experience. So we requested him to work with us on this project. So from that perspective, somebody answered some of the questions. Now some of the questions are missing now from my side. Brother Islam, you responded to the question which I was responding. So this has gone away from my. So just a request, Brother Islam, please don't answer any questions directly. If you want to answer any question, please raise your hand. So I'll request you to answer that one. Okay. So if you want to comment on this question, please go ahead, but please don't answer anything directly. Okay.
Thank you, Brother Umar. Oh, sorry for that. Yes, Pakistan has the pool management guidelines issued in 2012 and subsequently amended in 2013 through a circular letter. But there is a need to review the whole pool management guidelines due to the minimum deposit rate issue as duly highlighted by Maulana Taqi Usmani Saab in FPCCI meeting. It is a federal Chamber of Commerce on Islamic banking meeting. This is the serious issue, minimum and regarding the fairness and sharing of profit to the investment account holders. And in my opinion, in Pakistan, we have to do it because we do not have any proper governance framework to safeguard the interest of investment account holders with respect to the roles and responsibilities of boards or senior management or their committees. And it is not covered even in their term TORs regarding the monitoring, negligence, ignorance, and breach of contract in terms of safeguarding interest of investment account holder. Secondly, minimum and maximum weightages is three times in Pakistan, and in this document we recommended it is 2.5 times. And it is also made to clear that IBIs interpret their self that it is only applicable on the general pool. However, it is applicable across the pool. Whatever number of pools an Islamic banking institution have in Pakistan, 10 pools or 15 pools or 20 pools, general pools and special pools. This provision is application across the pool. Thirdly, profit sharing ratio is not rationalized and quantified because it is decided unilaterally by the investment in Islamic banking institution. So there is a need to rationalize and quantify the profit sharing ratio in terms of financial model and something else. And secondly, practicing of FIBA is continuously going on in Pakistan. So there is no bank having profit equalization reserve or investment reserve. So there is a need to maintain such reserve to for smoothing of profit and to abolish the practices of FIBA. These are the recommendation from my side in terms of looking into the draft standard that have to be considered by the Islamic banking institution and State Bank of Pakistan as well, with respect to review of existing instruction on pool management and profit calculation and distribution mechanism. Thank you very much.
Thank you very much, Brother Islam. So in a nutshell, as Brother Islam answered, Brother Mustafa Jarun listen that nutshell, this standard builds upon what was there in some of the important regulations across the globe, but it is much more detailed and covers much more detailed aspects. And some of the requirements that were there in some of the regulations, we are tightening up those requirements. And actually, that is where we would like to listen from your comments as also, because we are getting some, honestly, we are getting some some of the market participants somehow, and a couple of regulators, they've approached us that they feel that it is going to be too much restrictive and too much the problem is the way of Sharia at times is restrictive. Honestly, the Sharia always define restrictions in life. I don't have it allows everything in life generally unless it is restricted. So the problem is whenever it comes to Sharia, you have to find out what is the restriction. Ibadat are things that need to be done. But other than Ibadat, it's all about finding the restrictions. So whenever we come up with some standards, people have a feeling that, okay, we are coming up with restrictions. So in a nutshell, I would love to listen to those points. I have another comment in the question and answer tab, but I can see a couple of comments in the chat window. Again, I request, I'm not going to address anything in the chat window. You are requested to put things in the question and answer tab. There is a comment from Brother Qadir Tore. Thank you very much. Thank you, Sir Ansari, for your presentation. My pleasure, dear brother, and thanks to you and all the participants for being here and making it a successful event. About the inclusion of PR and IRR in the CAR, I think that IFSB answered this question through its standard by considering PR IRR as risk-weighted asset with the factor alpha that might show the confidence of the regulator about the capacity of above reserves to smooth profit and avoid DCR. I think Brother Qadir Tore, very good comment, highly appreciated, agreed, and that's why I was saying that it's IFSB's area. I think you are just missing out one thing, that DCR is also include the HIBA element. So even the HIBA element, in addition to PR and IRR element, are to be considered. That is just my small comment on that. I don't want to go into more detail for this part because this is the regulatory part which we leave to IFSB. Again, thank you very much. So there are a couple of comments I can see in chat window. So, but my request to the participant is this: please, if you feel that those questions are still unanswered or not addressed, please put them in the Q&A tab. Now I'll move ahead with this part, and again we are just 20% of the standard done, and we are 80% of the time done. We have only 22 minutes left. I was just checking and discussing with the team that the time available for this public hearing for this long standard and this very interesting and complicated subject is not enough. What we will be doing is that probably we are supposed to have at least one more public hearing. So today we will cover some some initial sections after the definition and all this initial discussion. Some additional sections will be covered, but I'll give you just a brief about the contents of the standard. You can provide comments in writing as well, and we'll invite you for the upcoming public hearing as well. In the upcoming public hearing, Sister Zahra, Sister Alia, please make sure to invite all of the today's participants, because we need to inform that the remaining sections will be covered in more detail in the upcoming public hearing, inshallah. And maybe instead of 3 public hearings, 4 public hearings might be needed, because even in the last public hearing, the time proved to be insufficient for discussions. Yes. Now, the next section is about the core principles of governance of investment accounts. So we say that the core principles include Sharia compliance, fairness, fiduciary responsibilities, accountability and risk management, and internal controls have to be there. Transparency and disclosure is a very important part. Responsibility has to be there, and investment strategy has to be in place. And proportionality principle, depending on the size and nature of operations of the institution, should be there. And code of conduct and ethics need to be applied. So these are the core principles. These are generally in line with the core principles of governance that AOIFI has, but there are some specific core principles that we have amended or added for the purpose of this one. Then on the core principles, additional considerations for HRIAs include additional transparency and disclosure, and different and more detailed investment strategy, identifying the risk factors involved as well. Organs of governance and management that are involved in the overall process include those charged with governance, that is the board and its committees. Then there are governance organs reporting to those charged with governance, that is internal audit function and internal Sharia audit function. Then there is Sharia supervisory board, and there is management, including senior management and respective management committees, etc. Compliance department, risk management department, and Sharia compliance department. Then we have the external stakeholders, that is external auditors and external Sharia auditors where applicable. So these are the stakeholders, and we have identified at different stages of the standard the requirements related to different stakeholders. Organs of governance shall be responsible and accountable for compliance with the requirements of this standard and Sharia compliance according to their respective responsibilities. Part B is a very important aspect of this standard, which was not covered in AOIFI's earlier standards or any other place, I believe. That is that for investment accounts, there must be a very proper strategy and policy framework. Okay, AOIFI's other standards require general policies and procedures and manual systems, Sharia compliant processes to be in place for all the functions in general. But this is more specific. So we are saying that one document, which is to be called as IA's strategy and policy framework. So the strategy has to be there, the policy has to be there, and the main contents what are to be there are defined in this section. So we are saying that strategy and policy framework shall be developed in accordance with the requirement of this standard. It should be vetted by the SSB and approved by those charged with governance, that is the board. The specific considerations that are to be there include that HRIAs and should be encouraged, and LRIAs obviously should be there. And the policy, but we believe that HRIAs are close to the true spirit of Islamic banking and finance. That is the view of our governance and ethics board, that HRIAs, that is not mimicking the conventional, but actually having the risk and reward and actually having the variable returns, should be the the real form of Islamic finance, and it is closer to the true spirit of Islamic finance and banking. However, we said that it should not compromise the consideration related to the risk appetite of the IH and different classes and types of IH in line with the requirement of the standard, which means that while we encourage HRIAs, but we still believe that low risk investment accounts are acceptable. Significant components of IA's strategy and policy framework shall include, but are not limited to, the following. So these are the main sections. So for each of the items, in paragraph 14, we have a whole section in this one that what would be the content about that. So paragraph A is about solicitation of funds for IAs and respective prerequisites. So paragraph 16 addresses that. IA's risk management policy, obviously risk management policies are there, but we have identified the unique aspects here. Creation of investment pools and identification and segregation of funds and assets, commingling of funds, priority of investment funds, determination of PSRs and weightages for profit, for distribution of profit, movement, transfer of assets between investment pool, tangibility criteria, profit and loss computation, attribution and distribution, profit smoothing and capital protection techniques and maintenance of risk reserves, promotional gifts and prizes, IA Takaful scheme, what we call generally as deposit insurance scheme, termination, early redemption, transparency and disclosure, internal controls related to IAs. So these are the sections which provide the guidance on the policy framework. Right now, because of limitation of time, I'm not going to go in detail for the whole aspect of the IAS strategy and policy framework, but I'll guide you through the whole process. So this will be the approach that institution shall develop all these sections from para 16 to 56 in line with the above sections that I identified while developing the IA's investment policy. So IA's policy framework, strategy and policy framework. And these all sections are part of the policy strategy and policy framework. And this document, as we said, it will be a detailed document. It will be a manual. That manual should be vetted by the Sharia Supervisory Board and approved by those charged with governance, that is the Board of Directors and its relevant committees. Again, and if you have any comment for those who have read the standard in detail, if you have any comments on part B, I'm very much here to take those comments. But my approach for today's presentation is to just try to cover all the remaining sections. So part A was, we have the definitions, and part A was about the core principles that apply. Part B was about the overall policy strategy and policy framework, that what should be there. Then we have pre-commencement considerations, and then this is the process flow, how we move ahead. So next sections, next parts of the document are on the process flow. So pre-commencement, you must have implementation of IAS policy, strategy and policy framework. So we are saying that there must be a strategy and policy framework in line with all of these requirements above, and that should be in place before you start offering the investment accounts. And those institutions who have already, obviously all of the Islamic financial institutions that are already in place, they will be having a time to follow this requirement. So as soon as the standard become effective, upon its effective date, they must have this whole policy framework ready, and they need to get it implemented. So it is the 2 days. So before commencement for the new institution, before commencement, and for all the existing institutions as of the effective date of this transaction, they need to have it in place. Now, the human resources, that before soliciting funds for investment accounts, you must have adequate human resources in place, particularly related to investment pool management and profit and loss distribution functions. Respective roles and responsibilities should be properly defined, and institution, then IT infrastructure has to be in place. So IT infrastructure is must for it. We can tell you that just like following any conventional banking system and offering Islamic finance offerings like investment accounts is sorry to say, please don't quote my words, but I would say it's a fraud on the back end. That you are not actually trying to do what the product is. You are just trying to make a bunch of paper, and on the back end, you are doing exactly what the conventional is doing. And that is the reason that we always insist that the core banking solutions should be properly compliant with the AAOIFI Sharia accounting and other standards. AAOIFI itself certifies some of the IT system providers, and all the institutions are recommended to follow only those which are certified either by AAOIFI or by other reliable institutions to be compliant with the relevant Sharia and accounting requirements. But let me mention one thing. If you don't find a good Sharia compliant banking solution on on an overall basis, is still having a module for profit and loss distribution according to this standard is mandatory. You cannot start offering Islamic investment accounts unless you have an IT system capable of doing and complying with the requirement of this standard. Then we have the requirements what the system should be capable of, complying with the requirements of Sharia standard, complying with the requirement of this standard, managing reserves, etc. Then we say that IT infrastructure should invest investing in the IT systems, but for public interest entities it is a must. For the smaller entities, we allowed some flexibility that still they are encouraged to invest in acquiring a proper module and proper system. Certification of the IT infrastructure for this is required. Particularly for the public interest entity, I think we made it mandatory, and for all others, I think, public interest entity, we said that it is a must. For others also, it is preferred. So the IT system should be certified by a third party. AAOIFI also provide that service, but that can be provided by anybody else. But the requirement is that it must be there as a certified system. Part D is about consideration at the stage of account opening and contract. Now, at that stage, there are so many things that need to be disclosed and clarified. And this is where we have this whole section on the considerations at the stage of contract and account opening. And first is the minimum content of the contract and account opening form applicable to all investment accounts. So what would be there? Like, for example, clarification that the act of IH investment in the respective IH by virtue of signing the contract signifies an act into entering into Sharia compliant contract, that these will be invested in line with Sharia compliance in principle, that the institution will be working as mudarib, so the respective rights and responsibilities of the institution need to be defined very properly, including like any restrictions, etc., which are there on the mudarib. Then institution shall be liable for losses from its negligence, and each fund will be invested as per investment policy of the institution in accordance with the conditions agreed in the contract. Whether or not, to what extent institution has right to commingling of the funds and the similar contract, etc. Whether or not, to what extent institution has right of commingling of each fund with other each fund obtained under different contract like wakala with mudarba or musharaka. The institution has the right of periodic change in the profit sharing ratio, whereby for this we have a specific requirement that while they have the right of changing the PSRs and weightages, but it should be done in a proper way, for which we have a very clear requirement going forward in the standard, very detailed requirement. So it's not just a unilateral act. Whenever I want, I can change it. You need to follow a specific procedure for that purpose. And then about profit and loss, profit and distribution according to AAOIFI framework or any other framework that you need to define in line with Sharia principle with rules. So even if you follow IFRS, you need to clarify that the compliance with Sharia principles and rules is needed. And I can clarify one very important thing here, that people at time in the countries where IFRS is followed, the timing of recognition of revenue from Sharia standpoint, what is the right profit and loss according to Sharia, these are very important elements. So at times you may have a requirement of following IFRS because it's a legal requirement, but for the purpose of computation of profit and loss, you might need to apply either AAOIFI phases, or you need to amend some of the accounting policies for profit and loss computation purposes. This is a very important point. I can tell you this is something that makes halal as haram. For example, if I did a Stasna transaction and I started accruing return on that before actually acquiring the good and selling it in the market, this means that I'm having money on money. And if I distribute that money on money to investment account holders, so effectively I'm doing something wrong, which is not in line with the Sharia principle, which is not in line with the nature of the transaction. And for a layman like me, who is not a scholar, For me, it tantamount to riba, honestly. It's me. I'm not giving a fatwa. I'm not eligible to give a fatwa. But I'm just saying that just booking money on money and distributing it to your investment account holders. So this is where it's a very important point that only the financial accounting standards of AOFI are there, which addresses this issue. And this is where we encourage all the regulators to adopt AOFI standards because of these sort of challenges. The institution has its absolute discretion when decide to pay hiba or reduce its share profit from time to time. Clarification on the rights and risk applicable to IH, including the fund provided, shall be treated on a participatory basis, etc. The profit shall be distributed according to PSR, etc. Risk reserves will be maintained, and loss will be there in the proportion of the investment. Identifying governing laws, Sharia rules and principles, governing law, applicable regulations, etc. These all should be defined. Then these were the general requirements for all investment accounts, but now in this section we have specific requirements for contract and accounting form for the HRIAs, including restricted investment accounts. So since they have higher risk, etc., so the risk profiles and the intended investment pool, etc., restriction imposed on RIA, they all should be disclosed. Experience and capability of the institution and management team should be disclosed. Disclaimers about the performance of investment portfolio, etc., should be there. So these are additional disclosure requirements to ensure that the risks are adequately communicated before making the investment, including if there are any any restrictions on early withdrawals, redemption, exit, if there are any front end or adjustments, cost to that, front and back end adjustments, and then if there are any comminglings, etc. So all these need to be disclosed, and the confirmation of ICE investment objective and a statement that they understand the relevant risk. This all should be part of it. Then there are minimum disclosure requirements. So so this is the part of the form, but then there are disclosure requirements. So investment policy should be available to them. The risk appetite for underlying asset, etc., should be identified. Relevant products, etc., should be identified. Profit smoothing techniques that are being followed should be identified. Commingling of other funds and its potential impact on them should be identified. Previous periods declared profit should be provided for a reasonable period disclosure. Indicative profit rates, mechanism of charging impairment credit losses, zakat deduction where applicable. Time-bound IAs, the respective premature withdrawal terms and mechanism. Now again, for time-bound IAs, the premature withdrawal requirements are significant. So at times they impact things big time. So for that, we have a separate section as well. A very detailed section covers it. There is something in the Q&A tab, Brother Naveedul Zafar. How a conventional bank intend to convert into Islamic bank would require reopening all accounts on Mudarba basis, or just convert existing accounts in its core banking system marked as Mudarba account and create pools? No, you need to have new contracts, and there will be new accounts and new contracts. This has to happen. On the conversion, Brother Naveedul Zafar, AOFI is right now in the process of developing a standard. There is a Sharia standard, but we are doing a governance standard. Sister Zahra, please make a note of this point. We know that we have covered this thing, but just to make sure that we don't miss it out. Yes. So the conversion standard is in the preliminary study stages. We have got some of the working group meetings. In the upcoming meeting of the board, we'll be discussing the preliminary study, and after that, we'll be writing the exposure draft. Probably our target is, if possible, before end of the year, or maximum first quarter of next year, we'll be coming up with the exposure draft on that part, inshallah. Thank you very much, Brother Naveed. But in a nutshell, the answer is you cannot convert directly an interest-bearing account into Islamic account. You need to close that account and you need to open a new Mudarba account. And for the new Mudarba account, you should fulfill all the requirements which are contained in this section. Then we have minimum disclosure requirements at this stage. Then there are some disclosure requirements. These are quite detailed disclosure requirements ensuring transparency and disclosure. The next section is about ongoing considerations. So there are ongoing, at times there are changes in the IA's strategy and policy framework. So this section covers it. Then there are requirements related to beginning of the profit and loss period, that if there are any changes to the PSR and weightages, they should be disclosed in a transparent manner. And all these requirements are here, transparent. So main requirements are that whenever you change the PSR, etc., it should be done in transparent way, in a timely way, in a detailed manner. We have asked a requirement of 15 to 21 days before the commencement of the period. You cannot just say, okay, on the night or the evening I did it, or maybe you do it 10 days later and you just backdate the notice. This is all not allowed. If you want to change the PSR, you should be doing it a reasonable time before, and then you should allow anybody, if they don't want to agree on the change weightages which are unilaterally changed by you, they should have an exit without having an impact. So it can be done under a appropriate means of communication and under a deemed confirmation approach, but they have a right to withdraw without material losses. Then if there are transfers during the PLC period, so for the transfers, we have requirements according to the Sharia. There is a whole section on that as well. So we have created the policies on the policy framework. One of the very important requirement is that it should be performed in line with requirements of respective AAOIFI FAS also, because FAS has put in some requirements. So for that purpose, the requirements of FAS should be considered requirement of this governance standard as well. Then periodic computation and attribution of profits and losses will be there, for which we have this section. This is about during the PLC period, at the end of the PLC period. So these are the requirements, how it is done. So there is some guidance with regard to the attribution of profit and calculation and distribution of profit in this section. Then we have, again, it's a quite detailed section, as you can see. We'll try to discuss this one in more detail in the upcoming next public hearing, inshallah. This section is quite detailed, you can see. Then payment of due profits should be done in due course, and if it is not done within time, obviously there should be a compensation mechanism if the profits are not distributed within time. What about the treatment of undistributed profits? What about the constructive liquidation, and what are the impacts of constructive liquidation? So these are the requirements related to that. Distribution of profit on account, in the situation where profit on account is distributed, means ad hoc profit is distributed, what would be the treatments? Again, unclaimed amounts, etc. are there. Then responsibilities on the ongoing basis, there are responsibilities and authorities of those charged with governance, Sharia Supervisory Board, and Sharia Compliance Department with regard to the ongoing considerations of profit and losses. One very important thing on those charged with governance is that ensure implementation of the policy framework and ongoing supervision and monitoring. So those charged with governance through a committee, because that committee concept is there, that those charged with governance, that is the board of directors and its committees, they can create a specific committee, or they can delegate some of the function to an existing committee. But preference is there should be a dedicated committee for that we have called as investment accounts committee. Brother Islam touched upon on that part earlier. So with that, then we move to the considerations on redemption of investment. So redemption can be done at the end of a PLC period, or it can be done during the continuity of the period. So we have seen a lot of injustice and unfair treatments in practice in Islamic financial institutions during the redemption process. So we have put in some requirements related to that. These are again quite detailed requirements. We can take any comment, but since the time is almost over, so as we discussed that, we will be discussing it in more detail in the next public hearing session, inshallah. Then there are considerations on liquidation of the institution. This is something that was not there in the AAOIFI earlier standards, and since it is linked here, so we have written it down here. But probably maybe personally, I believe it requires a separate standard by itself. But till the time we don't have a separate standard on this one, we can keep this one in this one, because more these are the main differences from the conventional side. Then we have part H on the transparency and disclosures. So we have quite detailed requirements on the transparency and disclosure requirements, which include some of the requirements related to the financial statement. Financial statement disclosures are mainly covered in our financial accounting standards. So we have said that those requirements are somehow reproduced in this standard as appendix. And then we have put in periodic communication related, and general profit rates related, past trends of profit related, general disclosure of our investment account holders, etc. These are contained in here, and and some of the considerations for transparency and disclosure are in the hand of the auditors of the financial statement. Some are in the head of the external Sharia auditors, and some consideration in the Sharia board report are needed. The new Sharia board report that we are finalizing right now, that was a part of the exposure draft that was issued last year. That one includes specific reporting on the investment accounts part. So this is like correlated with this one and with that one in the Sister Zahra, just make a note of it. Just we need to match the wording, and we just need to make sure that whatever requirements are here are included in that, that illustrative Sharia board report. Okay, just need to make sure if the point is there. Just we need to align it together if needed. We have suggested for having Sharia compliance and fiduciary rating, for which we have our other standards on Sharia compliance and fiduciary rating for Islamic financial institutions, and Sharia compliance and fiduciary rating for Islamic financial instruments and instruments, Sukuk and Islamic finance instrument. Sister Zahra, I think the footnote reference should be to the both, even because it's possible that institutions can. Okay, no, I think yeah, sorry, that is covered in second one. My apology. That 132 is about that, so that is covered already, and particularly for HRIA. Now, effective date is suggested to be 2026. We have not put very aggressive. If we finalize it within 2024, so still there will be 1 year. Plus 1 year plus before that becomes effective, but still we would like to listen to the market players if they feel that it is possible. With regard to the transitional provisions, we understand that there are market issues, so we have inserted some transitional provisions, and we would love to listen to the market participants about the transitional provisions. About adequate level of risk reserve, we discussed already. Here I will stop because the time is already over. With your permission, like I know it's a bit late, but with your permission, I'll very quickly address the 2 questions that we have received. Brother Mufti Khwaja Nur Hassan, referring to your just response to some recipient, what if the bank is aware after the closure conversion of account that X amount is interest and Y is principal? So what if we advise? I think Brother Mufti Khwaja Nur Hassan, the answer will come is in the Sharia standards, and will come for will come for the conversion part. But from our perspective, we will not go in the governance standard on this Sharia aspect. But yes, just for your knowledge, I would like to mention that our Sharia board is also having an agenda point in the short-term future to develop an updated version of the conversion standard on the Sharia side. So I think this question can be passed on in due course to the Sharia team. I would suggest if you can just pass it on, this question, to us in writing. We will just make sure that it is passed on to both teams, that is the governance team and the Sharia team, to make sure that in the conversion standard on governance side and the conversion standard update project on the Sharia side, it is covered. Brother Khwaja Nur Hassan has another question. Any rating company who's performing Sharia rating as per AAOIFI standard? Brother Khwaja Nur Hassan, the only agency that is working right now is one of the Islamic finance infrastructure bodies, that is Islamic International Rating Agency, is IRA, IIRA. IRA is actually doing this in different countries. Even in Pakistan, I believe they did it for Faisal Bank. So they are offering this service already. So I think you can approach them directly. We can provide you the contact. If you drop a message, we'll provide you a contact. But I would recommend all representatives of Islamic financial institutions here that they should consider having the Sharia compliance and fiduciary rating for their institutions. Obviously, ERA is already providing, but we want more players to come in. A standard is already in place, so the things are open for the players. Then we come to Brother Sadaqat has raised a point. Investment risk reserve is the amount. This question: the ultimate beneficiaries of the amount appropriated and accumulated in the IRR are the investors, which should be given back proportionately to the investor in the time of maturity of investment deposit. Brother Sadaqat, I don't agree that all the time you should have it at the time of maturity of investment deposit, because it would be according to your contract with them that it can be because investment pools are continuing pools. So if in case of a pool, Sister Zahra, I think this point we should note it down. I know that we have covered it somewhere, but we just want to make sure that what happens if the investment risk reserve related to our PR related to an investment pool and that pool is liquidated. So I think we have that option that it can be passed on to other pools or it can be liquidated and paid them back. So we need to know what is the contractual requirement. So we cannot, Brother Sadaqat, we cannot dictate it. It will be driven by the practices, like a contractual agreement, because it's a tabarro. The way it works, the way reserve mechanism works is similar to the takaful mechanism. So from that part, this is something that we would like to, still keep it in the hand of the investment account holders. I think we covered it partially somewhere, but your point is very, very important. So I just request Sister Zahra that just discuss with me at a point that we just make sure that Brother Sadaqat's very important point is addressed properly. But we cannot enforce, Brother Sadaqat. We can encourage. So probably we'll see how we write it, but we can encourage it, but we can enforce it. Thank you very much, Brother Sadaqat, and thank you everybody for patient listening. I still can see a lot of comments coming on the coming on the Q&A tab. But honestly, sisters, what I suggest, note down all the comments that are there on the Q&A tab on the chat window. But I will not be answer them right now, but we'll take them to the working group in due course if they are relevant. So because we requested several times and the comments were not there in the chat window and in the Q&A tab and the time is over. So with that, I would like to thank you all and back to Sister Zahra for closing remarks.
Thank you, Brother Umar. Thank you for the participants. Thank you for Al-Nasah for their partnership. If you have additional comment, please feel free to share with us on governance@aifi.com and check our website and social media platforms for the details about our upcoming public hearing. Thank you very much and fi aman.
Thank you, brother, and I thank you.